bad performance seems to bring bad luck along with it.
Yeah, so it's funny actually when you look at poker players. This was actually something I spoke to Angie about last week. When you are on a winning streak, you tend to make better decisions, and when you are on a losing streak, you tend to be more emotional, make worse decisions.
Right.
And so there's this like common like theme in poker, which is okay, when you're winning, the other problem with poker is the amount of money you're playing with is higher at risk at any point in time because you kind of run up your stack to a higher amount.
Yeah.
So there's always the question of should you cash out, and the answer is often it depends, and that's an awful answer because it doesn't give people the kind of clear direction they want. But if you're playing really well, it's actually not the worst thing in the world to have a slightly larger stack and feel like as long as you're continuing to make good decisions, that's great. And if you're feeling really uncomfortable about what's at risk, then you should probably downsize and move to a different table.
And that was the day before CPI.
Yeah.
I was at my highs for P&L on Tasty, and that was going really well.
Yeah, and you felt like you were making good decisions, or you felt like you were in a good spot, or do you feel?
Oh yeah, and it was like $300 a day.
Yeah,
it was just paying because it was like my theta, but almost double theta.
Yeah.
Because vol was coming down as well, and it was just great. And I wanted a button that I could press that would take the whole thing off.
Yeah.
Right, so I actually did say to Dr. Jim,
which is just a close all button.
Can we have a close all button? Because it would be, it'd be such a great addition. But since then, it's more my IG, so my European
your CFD
and S&P CFD.
Yeah.
Now, just a quick note on that. I mentioned Dr. Jim there. If we could just pop up.
I love Dr. Jim. It's the show that I most regularly and religiously tune into. It's great.
And so Saturday.
Yeah.
They're doing this fantastic thing. So it's the beginner trader. I mentioned it yesterday. We'll pop the link up on the chat as well, because you've got to register prior to the minting date of 10 a.m. on Saturday. That's 10 a.m. New York. So this is a chance to watch Dr. Jim for 90 minutes. He's a former professor. Really great at what he does.
So good at explaining stuff. I think especially when it comes to some of the more sophisticated option stuff, I think he's just really, really good at clearly explaining what's going on mechanically and why.
Yeah. So that's your Saturday afternoon. If you don't want, if you're watching the football because it's at 4 p.m. UK time, you get the second half of soccer Saturday. Then if you register, you have got access to the digital collectible.
Yep.
And you can watch it anytime you please. So that's your Sunday afternoon. But yeah, chart down on that one. Thanks. We're going to post. There we go. Brilliant. The link is already up there. The boys are on fire out in the gallery. Terence, Caleb, and Fred. Killer combination.
Yeah. It's the A team, right? Yeah.
The A team. Yeah, that's right. That's why we hear the
sound effects. The sound effects are amazing, though.
Cam and Phil aren't going to be happy at that.
Well, they're all the A team. They're all.
I don't know. You just threw that out there.
Yeah. Okay. Well, let's see if I get. Should we talk a little bit about the psychology stuff there?
Yes.
Today?
Let's do.
So I think when you're in that state where you're not necessarily making good decisions, one of the things I wanted to talk about is how you think about the number of different positions you should look at any point in time.
Yeah.
So I think there are two different concepts that are kind of related to each other that are worth thinking about. One is about focus and one is about fragmentation and kind of task switching and inefficiencies and trying to do too many things at the same time. And they're kind of flip sides of the same coin, which is if you are focusing on a small number of things, you tend to be doing those things more effectively. There's like lots of really great research on, for example, deep work, which is how you do deep blocks of focus time, or how you think about how effectively you're making decisions if you don't have too much kind of cognitive load on at the same time. So if you ever want to experiment with like how good you are at dealing with cognitive load, try and do something complicated while counting down from a big number like 1,000 in lots of 7. What you'll find is as you start counting down from
993, 986.
Yeah, and then try juggling while you're doing that. And you'll find your whole brain, or try doing anything that you can normally do, but requires a bit of thinking while you do that. And you'll find that your brain just totally shuts down. And the reason for that is because at any point in time, we can only tolerate a certain amount of cognitive load. And so if you are focused, you're much better at allocating that load to the stuff that matters. And when you're not focused and you're fragmented, you tend to be doing that stuff really badly. So
now, but then where do we sit with diversification?
Right. So I think this is where, as a trader, it's really interesting because there's a trade-off in the other direction. So you've got this kind of psychological phenomenon, which is doing fewer things but doing them better is better for your decision making. That's really, really worth knowing. There's also some interesting stuff there, which we should go into, but we probably don't have time, around like working memory and how many things you can store in your head at one point in time.
Yeah.
Basically, there's a finite limit on how much stuff we can do, given where we are and what our understanding level and maturity level is. The trade-off with that is that actually, as a trader, we might want more positions because it provides a hedge, it provides more diversity, it allows us to downsize the size of those positions, and so then the risk associated with each one is smaller.
Yeah.
And so then there's a question to me about A, where on that spectrum do you want to sit? And then B, how do you think about, if you have a large portfolio of positions, how do you think about at any one point in time, which of those do you focus on? Because it doesn't have to be the case that you have to have a small number of positions to have focus. What you can do is, if you have like 15, 16 positions, you can actually at any point in time really be thinking about 2 to 3 of them, and then you can kind of create a pause period and think about 2 to 3 different positions and do it almost sequentially rather than trying
As in a time period. So guys, if we can put my portfolio up here.
Yeah, so we're going to look at this is your Tasty portfolio.
So this is the Tasty portfolio, and we worked out there's 15 positions there because one of them is options, and that's a hedge against the whole lot.
Option on S&P futures.
Sorry, it's futures.
Yeah.
One of them is futures to hedge all the options.
Delta, right? Yeah.
Yeah. So right, let's go through. So there's 15 of them.
So there's 15 of them, right? So when you open a portfolio like this, like what do you normally do or think when you're looking at all of these positions? We'll do this as like a kind of live working session.
I would say, right, let's group together the ones that have some kind of relationship.
Okay, and how would you normally do that? Like let's look at this portfolio. You've got Nike, Eli Lilly, you've got Nvidia, Palantir, Microsoft. I guess you've got some tech names here. You've got some kind of more traditional blue chip stocks. You've got things like Rio, which I think are more kind of commodities plays.
Exactly. So traditionally in a bank, you're sat by industry. So my thinking would be, right, Nike and Deckers.
Yeah.
They're a group.
Yeah.
I have to think about the same things. Then, something like Palantir and Nvidia.
Yeah.
You might put in the same bucket.
Because they're like AI-enabled companies, right?
Yeah.
So I think what you're doing there is actually a quite common strategy that's called chunking, which is where you take a large array of small things and you chunk them into either like kind of cohesive bundles that make sense to look at together. And then instead of thinking about 15 things, you're actually thinking about 4 things, which is like US mega cap AI-based tech. You're thinking about like blue chip stocks. You're thinking about commodities, and then you're thinking
Consumer
about
facing,
consumer
yeah.
stuff, right? Yeah, exactly. And so then that already helps you think in this kind of slightly more focused way, because let's say then, instead of looking at all of these, we're just going to spend 20 minutes to 30 minutes, maybe even longer, just focused on some of the AI-based tech names. Yeah. And then you can have a think. Actually, it's good at that point that you've got multiple names in your portfolio because they provide hedge. But you can also think about the thesis overall, and you can think about how those names kind of complement each other or provide substitutes to each other. And so you can try and generate some of that focus by grouping stuff together.
The only portfolio manager I've ever seen do it properly was a guy called Rod Rodriguez, and he was at Bluecrest. I'm not sure where he's moved to now. I had the fortune of working with him for about 4 months as our paths crossed. And the whole team, there was 5 of us in the team, we'd all sit around one computer and we'd go through the whole portfolio stock by stock every single morning at 9 a.m. Coffees,
Before markets open, like just getting yourself. Oh,
9 a.m.
9 a.m.
Europe
as the
was
markets
already open.
Wow. Okay. Cool. That's interesting. And you think it drove high performance in that team because you could see what others were even thinking and why.
And the focus. We all knew the positions.
Yeah.
And if you had a counter argument, then it was encouraged that you voice it.
Interesting, because so a really good parallel to that is something called pair programming. So in a lot of software development, there's companies like Shopify is a really good example of this. They're massive believers in pair programming, where 2 people sit at the same computer, and they write and rewrite code. And this is like so counterintuitive because normally having two of you on one PC, you're going to halve the productivity of that team, right? But actually, because you're forcing each other to think out loud about the quality of the work you're doing and you're trying to make deliberate, thoughtful decisions, what you end up producing is much, much higher quality and is well worth the loss of the productivity of two people working in parallel.
Wow.
And so there's a whole field of people who love pair programming, but actually I think doing something similar with a portfolio actually I think is a really, really great practice to generate focus.
And of course, the other way is this great thing on the Tasty platform, which I am just, I cannot speak highly enough of. Grouping it by
theta, gamma,
or vol. So if we can just pop that up quickly, guys. So, I can rank, I can see exactly where, if I'm losing money because vol's up, I can see where it is. And you can see here, I'm short a lot of Nike vol because I'm so short the puts, but also short calls higher up. Lily, I'm short 140. Or
you can look at the I think the theta is also fascinating, especially if you're a seller of options, right?
Yeah. So I'm getting $80 a day from Nike, 43 from Deckers, 36 from Palantir. But of course, Palantir is going up in a straight line. So I'm short a lot of calls there. Ranging from 125 up, and it's at 124.60.
And I think that's one of the benefits of the Tasty portfolio is you can do that same grouping, but not just by industry. You can do it by the type of position you have, which I think is a really thoughtful way to do that kind of re-chunking of the work. I think one other thing to keep in mind is like sometimes when you're looking at your portfolio, it's because you're reacting to information, and I think thinking about that also in a way that's not too aggressively reactive and bit by bit is also really important. So if you've got a big macro news event or you've got a big earnings release that's coming out that's going to change how you think about your positioning, you need to actually like think about planning in advance, like what is likely to be impacted by this, and like if we were to stack rank in priority order, what are the first 1 to 3 assets you would want to solve before you go and do anything else. That helps you generate that focus. And if you don't do that, the kind of flip side of focus that we spoke about is fragmentation. And the reason fragmentation is really bad is actually if you keep swapping from one task to the next, you actually end up having what's essentially a hangover period every time you swap, where you're kind of cognitively thinking about the last task rather than fully focusing on the task that's in front of you, and you make bad decisions. And like, especially if those tasks are like quite volatile, emotion-driven tasks, like if you're closing out losers, for example, it's very, very likely that when you swap to the next task, you're going to continue being in that heightened emotional state. Right.
Have you ever been hijacked before?
In what like context?
Do you have a 9 a.m. meeting?
Oh, yeah. I'd
love to have you here for the opening bell, which is in about 60 seconds.
I can stay.
We'll let you out at 9:02. Oh, 5 minutes, even better. Right, let's go into the all sessions opening bell then.
Wait, should I ring it? Where is it?
Oh, will this be your first time ringing the bell?
No, I've done it once before.
Don't worry, you've still got 50 seconds until we're there.
Do you have a pen?
And catch. Oh, look at that. Through the opening on So what stocks in particular are you going to be watching on this open? There wasn't really much last night, was there?
I think it's been quite a quiet day or so. I think this week in general is a bit of a lull week.
Occidental.
Oxy is the big one, yeah. Oxy was in our week ahead look last week.
Yeah,
so I'm keen to see what happens with that.
I'm actually not sure if it's all sessions, that's the only problem.
Oh yeah, because I guess Monday also was closed in the US, and so you've got a bit of hangover.
Yeah, as well. God, it was dire. Right, you've got 10 seconds. I'm interested to see the skill set here.
There's a right and a wrong way.
No, count down from 1,007s while you're doing it.
No, I can't. Come on. 993. Oh my God, anything past 993 is a nightmare.
986, 979.
It's remarkably hard, right?
972.
There you go.
965. 958.
That's good.
What are they?
Do that while sorting for percentage change.
Okay, 951, 944, 937, 930, 923, 916, 909, 902.
That's really good. You can tell why you were a trader on the desk.
Yeah, true. It's about the only skill. Right, what have we got?
Let's have a look.
Intel dropping, big move yesterday, wasn't it? 15%.
Wow. It was a really major move. I think even seeing some of the other chip names, I think just huge moves. Like Nvidia was up 3.5%, which is crazy.
I mean, what an opportunity you've had. 3 times now, I remember Nvidia getting absolutely carted, August the 5th.
Yeah, and if you bought the dip each time, you would have been totally rewarded for it.
And with the earnings that they've almost got sort of guaranteed from that order book, then, you know, I've struggled to see why people haven't.
I don't know. I think there's people have concerns about Blackwell. They have concerns about like how real is this demand.
Yeah.
But I don't know. Like their earnings are just absolutely trucking on, so it's very hard to see them weaken at this point.
Yeah. So yeah, not much to go on this morning. Robinhood up 1.5. You know, that must be near and highs as well.
The Alphabet is flat. The Alphabet had a slightly rough day yesterday as well.
It did, and Meta as well. Meta down 3%.
Yeah. It's interesting. I definitely think we've had a kind of mixed week so far from Mag 7, where you've had some of them have like absolute monster runs like Nvidia, but like a lot of them have just been flat to declining, which is interesting to see. I think the can I give you my like sleeper prediction of
please
a small data release today that might actually be relevant to markets,
right?
Which is today you have the quarterly the QCEW, which is a data release from the Bureau for Labor Statistics. It's 10 a.m. US time. It might not even be on this list. It's a real wonky data release,
right?
So if you think about the jobs data that we get from the Bureau of Labor Statistics, it's almost always survey based. It's like, or it's claims based. So it's either a subset of the data or it's a survey of households or of businesses of like, what are they actually expecting employment to look like, or what do they personally look like, and extrapolating that to the full group.
Yeah.
So the QCEW is a quarterly data release with a 6-month lag, because it takes 6 months to gather the real data of the actual people who are payrolled.
Wow.
By companies in the US. And so it's the most accurate data we actually have, but it comes out super late. So today's release tells you employment data for Q3 of last year. But
okay, not that bad.
Not too bad.
October, well, end of Sep.
Yeah. So, I mean, it's a bit of a lag. It's definitely laggier than the weekly jobs data.
But that is when we had the huge revisions.
Yeah.
So this will be...
So the QCW is where a lot of the revisions come from.
Right.
And it's like super sleeper data, but it's data that like macro wonks love to look at. And so it's one that I'm looking at. I think that will give us a bit of a view of really how is the economy doing and how was it doing in Q3.
Do we know how the viewers will be able to find that?
If you go to the BLS website, if you just type in quarterly CEW and then BLS,
so that's the Bureau of Labor Statistics, BLS website, and then
the QCEW, the quarterly census of economic workers or employment and work, something like that.
Excellent.
If you can even pull it up on the screen and show them, it's a really easy one to find.
Good stuff. Right, Donald saying Intel has bounced back. Is there something in that story? That's going to be an interesting one to watch. But 9:04, I promised you 5 minutes. That's the 5 minutes up. So we're going to go to a break. That's your all sessions open. But Axel's joining me. We're going to talk German elections and the DAX.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction. Whether prices are rising, falling, or staying flat, there's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Welcome back. Right, we had a real quick change over there, and Axel in the seat. Axel, thank you very much for joining me, because it's the hot topic of this weekend. I've had the girlfriend with her voting sheet. She dropped it off at the German embassy yesterday. And so we just love, I think it'd be really useful for everybody to hear about the way that the German parliament's constructed, with the list and the local votes, the direct, and then, just perhaps what you're thinking ahead of it.
Well, I mean, basically, it's a system of proportional representation, and what we've had so far is a lot of coalitions ever since Angela Merkel had this grand coalition, basically, which was a mix between the Christian Democratic Union and the Christian Social Union. So these are centre-right parties, and the SPD, the Social Democratic Party. And she governed for a long time, I think it was 12 or 13 years, within that coalition twice, actually. And that was quite stable, and Germany did quite well during that time.
Yeah.
Ever since, it's been a bit more chaotic, to say the least, because basically these big parties, especially the Social Democrats, have lost a lot of their support.
Yeah.
So they're no longer the second biggest party. And the way it looks at the moment, judging by the latest polls from yesterday, it looks as if the centre right government, so the CDU, CSU, the parties, sorry, they're probably going to get around 30% of the vote on Sunday. And the SPD, which used to be traditionally the second biggest party, probably only about 16% of the vote.
Wow.
And in second place, instead, we have the far right party that everybody's scared of. That is the Alternative for Germany, alternate party for Germany, alternative party for Germany.
The AFD that, of course, we hear Elon talking about regularly.
Yeah. So they will probably poll between 20 and 22%.
Right.
But, and this is the important thing, at the moment, none of the traditional major parties would like to form a coalition with them.
No, because everybody's scared of the reputational effects. Now, is that just prior to the election? When we get the election result, are we likely to see, more talks, more open talks going on then?
Definitely. And at the moment, I mean, you can see here this nice little image Fred, our producer, has made up for us this morning. The most likely scenario is what is called a Kenya coalition. Germans love to use countries' flags for the coalition partner names. And yes, it's the colors of the Kenyan flag, and it is basically the center, right, CDU, CSU, the Social Democrats, and the Green Party forming a new coalition. That's the most likely scenario, because the Jamaica coalition, which would have included the FDP, the Liberal Democrats, instead of the Social Democrats, might actually not happen, because for the first time since 2013, it looks as if the FDP, so the Liberal Democrats, won't get the 5% threshold they need in order to be in parliament.
Wow.
They might only get 4.8%. And that, as I said, the last time that happened was in 2013. That was the first time since the Second World War. So that also means the so-called Germany coalition, if you look at the German color flags between the center-right, the Social Democrats and the Liberals, is very unlikely if they don't poll the 5% minimum requirement.
Yeah. Now, which one of those coalitions is best for the market? Which ones would be considered worse for the market?
The problem is there is no best scenario, unfortunately, and that's why the last coalition broke up, because the parties honestly don't agree on the major topics such as immigration.
Yeah.
Very controversially, recently a vote got through the German parliament by the center-right government with regards to limiting immigration into Germany, and that was supported by the AfD, by the far-right party, and that didn't go down very well. But basically we've seen a shift by the center-right towards the right in order to capture some of the vote from those people who vote for the AfD.
Yeah.
And they are at loggerheads with regards to the policies that the Greens, for example, want to introduce, or even some of the Social Democrats want to have. So it's not going to be an easy coalition, even if there is one, because they completely, on some subjects, such as the environment, fundamentally disagree on big topics.
Yeah.
And on defense spending, the involvement with troops in Ukraine, things like that, they disagree. Plus the way forward, the CDU-CSU would like to go more down the sort of Trump route by cutting taxes, reinvigorating growth, because after all, Germany has been in recession since 2023. And apparently, according to the latest forecasts, we are heading into another one for this year. That would be the first time since the Second World War that Germany has had 3 consecutive years of recession. Yeah.
So the way out of this is of course to relax the fiscal rules. And so which coalition would we be looking at for the most likelihood to relax those fiscal rules?
Well, the more the CDU-CSU has as a proportion of the vote, the more they can actually demand, and therefore that would be the best scenario. Now the question is, who can they team up with? If they team up with the Social Democrats, but their vote, as I said, is only 16%, then we would have a grand coalition again, if that were possible, but they might not get enough votes to do that. So they need another coalition partner. If it's the Greens are for the environment and don't want to pollute the environment, so therefore it's not necessarily very good for growth. Liberal Democrats, as I say, they would be a better partner because they would agree with a lot of these policies, but they might not get the 5% threshold.
So a major turning point is them getting 5.0.
Yes, probably. So in answer to your question, none of them is ideal.
Yeah.
Probably the 2 main parties without the AfD, so the center-right, the Social Democrats with the Greens. That might be the only one that we're left with anyway. So
yeah. And now, is it like the UK election that we get the results on Sunday night, or does it take a lot longer?
It is quicker than here in the UK, but yes, we will probably have them by Monday morning.
Okay. Yes. Right. So those vol traders on the DAX, then
they should be happy.
Yeah. Monday expiry could be interesting. It's fascinating, isn't it? Because of course we've got the DAX just, relentless. Shall we have a quick look at that and just update everybody on your thoughts on that? So
it's very simple. I've been saying for weeks, don't fight the trend. And a lot of people keep on doing it. I mean, it's making another all-time record high this morning. Why do you want to go short? Something that you think is expensive can become far more expensive than you can stay short. That's one thing. And the other thing is, investors or traders seem to think, yes, but the German economy is doing really badly. How on earth is the DAX making new all-time high? How can the FTSE 100 make new all-time highs? Yet the UK economy is not that great either. It has nothing to do with the economy in the short term.
Yeah.
I mean, what's happened at the moment is rotation out of US mega stocks, which are very expensive from a PE ratio, as we've been saying on this show for quite a while, into the relatively cheaper European stocks.
And it's as simple as you're selling something where you get a lot of dollars from, and a lot of money is chasing quite a small market cap country like Germany and like UK.
Exactly.
So, you sell a bit of Nvidia and you buy the DAX, you actually make an impact.
Yeah, sure. And also the other thing is 80% of Germany's companies make their money outside of Germany. They're exporters anyway. That's why Germany has got a trade surplus most of the time. And it's those companies which benefit from a weaker euro that we had over the last few months. I mean, now the euro is sort of appreciating slightly again. But it doesn't equate directly in a linear fashion to the German economy.
Yeah. Shall we just update people on the trade of the week there as well? We'll get the...
Sure. We went long euro-dollar, I think, 2 weeks ago. And that
US
looks pretty good at the moment. And for me, we're seeing a major reversal to the upside. Now, if you look at this chart and zoom out a bit, you will see that we are forming this bottoming formation here. We are not quite managing to break through these previous highs going back to the beginning of February, late January, but we've done so on cable, on the British pound against the US dollar. We've done so on the Australian dollar versus the US dollar. And you have to look at intermarket relationships, and it is quite likely, because of those having broken out and forming bottoms already now, that we might see something similar. This is a 2-minute chart, I think, on yours, so that's why it looks a bit different. If you go back to the daily, you will see that basically this breakout we've seen here in cable is what I expect to see with regards to euro dollar. At the moment, that's not the favorite view. Most people still think the US dollar is going to appreciate and we're going to go to parity. It may be the case, but technically speaking, for me, I'm long now because I know why my stop is. It's from the low 2 weeks ago, and basically, I believe that we'll see something similar happening. Now, it could be the German elections. Probably not. I mean, Germany is still the powerhouse of Europe, but if you look in growth terms, etc., France has done much better, and Germany is actually losing market share globally because their products are very expensive, because with the Ukraine-Russia war, German energy costs are still extremely high. And obviously, because industry needs energy, it is reflected in prices when they export, etc. Whereas the French government has subsidized their energy costs, and they're doing far better and growing much more.
Yeah, not a fan of the free market, the French, are they?
No, but it's good for their economy, at least in the short term.
Now, what about this week's? What about we move on to yen?
Dollar yen, yes. So for this week, we went short dollar yen. That one, actually, we didn't get into, unfortunately. I was hoping, can you see that first red candle that we had after the green one, that one? I was hoping to get in there on the next day, and we didn't quite get in there. So I still have that one open. If we were to bounce back, I still want to go short, because again, what I'm seeing here is on the chart a reversal from the 158 yen area. And what we're also seeing, and that's why the US dollar has fallen over the last few weeks against the Japanese yen, is that we now expect the Bank of Japan to hike rates at a more aggressive stance than we thought previously, and sooner than we thought previously. And that's why we're seeing this trend reversing. And it looks to me as we are going to retest the December low in days and weeks ahead, because for me, the trend is starting to change direction, the long-term trend.
So that was about 148.80.
That was 140 something. The low, 148.80? Yes,
yeah, I think
you're right.
So, yeah, just the bottom of that.
But longer term, if that is indeed a top, we could go back towards 140 basically, is my view.
Right.
Because that could be a big reversal to the downside, like we saw on the left-hand side here of your chart towards the end of last year, between July and September of 2024. That's not the view held by the market, by the way. That's my own view at the moment based on the chart. And my stop, you know, if I'm wrong, not when, hopefully if I'm wrong, it's just above the recent high at 156. So I know what my risk is. And I know you can see here that the potential reward is much greater than my initial risk. And that's why we put these trades on with, 2% risk per trade.
And we just needed it to get to that entry level, didn't we?
Yeah, but the reason I didn't just get in at market, even though I was convinced about my view, was it would have increased my risk potentially. Instead of 2%, it might have been 3%.
Right.
And if you start meddling with that, over time, your averages, where you have your average profits and your average losses, get skewed towards the losses. You don't want to do that.
This is where the discipline comes into it, doesn't it?
And yes, you might miss a few, but that's the way it is.
Yeah. Good. Yeah, the disciplined trader is normally the performer over the longer term. Now, Max, good question. Been wondering this for a while. Is a share buyback good or bad for the share price? Now, it depends what you're talking about. Direct effect on the share price, then of course it puts a demand in the market. In terms of fundamentals, then if you buy back the stock and you burn them essentially, then it's good as well, because in simple terms, you're reducing the number of shares. So earnings per share, you reduce the denominator. And you'll get better ratios. So yeah, generally, however, on a psychological, is it a sign that management doesn't know what to do with the money? You know, in theory, you've given them your capital to do something with because you think they can do it better than what you can. So if they're giving it back to you, then yeah, perhaps they think that it's the best thing they can do is the share price is so cheap. But it's not a direct answer, is it, Axel? What do you think?
Probably not, but there is still a lot of pressure, I would say, on management to do share buybacks, and that's why they're doing it also, simply because obviously they want the share of the company they're managing, the price of that to go up, so that the shareholders are happy. And the way to boost the share price, in a way, is doing share buybacks. Yes, definitely.
I would love to think it was just to make the shareholders happy, but yeah, we know that a lot of their compensation is based upon the share price as well, don't we?
Human nature.
Yeah, absolutely. Right, so yeah, we got a lot of interesting stuff there. Axel, any other a single stock that you'd like to take a look at that's been catching your eye recently?
Lloyd's is kind of interesting because of what happened this week with regards to the UK Supreme Court basically deciding that Rachel Reeves can't intervene with regards to the well, we can't call it a scandal, I guess, but the mis-selling of car insurance by the likes of
alleged.
Yes, alleged, exactly. And you can see that big candle down on that news. I mean, we dropped by about 4% intraday just 2 days ago, but the Lloyd's share price, and I wrote an article on that, you can find that on the website, or if you just Google it, longer term, if you go to a weekly chart, is actually looking kind of interesting, because what we're seeing there is we managed, before we had that short-term sell-off, to break above these previous highs, you know, going back to last year. So we went above those. Now, ideally, I want to see follow-through in the next few weeks, but you can see here, we've seen basically 5 consecutive weeks of gains in the Lloyd share price, and quite substantial gains. I mean, look at them. So that's pretty positive. And it is quite possible that we could head another 10-15% higher very rapidly in the next few weeks. So results out this morning. Tomorrow morning. So that's really one to watch out for. But if they beat expectations, who knows, that trend might well continue. So I'm quite interested in that one.
Yeah, and you do have the FCA that have been allowed to intervene in the Supreme Court decision there. So, you know, it does come down to those numbers. Can we see the result? Because we've seen great performance from HSBC, NatWest, Barclays. They've all, you know, it's a very different share price, isn't it? Yeah. So, yeah, one to watch. But thank you very much. Thank you for our... Do you still get to vote, even though you've lived in the country for so long?
Because the Germans changed their law with regards to voting from abroad, because they don't want people who are not tied to Germany directly to be able to influence what happens within Germany.
Yeah.
And therefore, I used to be able to vote when I worked for Commerzbank, Germany's second largest bank here in London.
Right.
But now that I work for a UK company and I don't have a residence anymore in Germany, I can't vote.
Right. So. God, that's fascinating. Good. Right. Thank you so much, Axel. Excellent. Always great to hear not just the technicals, but also our lineup for the German election as well.
Oh, by the way, on that note, very quickly, I'm going to do a webinar on that on Monday for IAG clients. So if you're interested.
Excellent. Where can people sign up for that?
Just contact your client manager and they will put you in touch.
Brilliant.
The relevant people.
We'll be on that one. Excellent. Right. We got a really interesting show for the rest of the morning coming up. We have the first ever live podcast. That's right. Luke Moore and the chaps at around 9:45 are going to be doing a live podcast. Join us for that. It's going to be real interesting. It's like our version of Coronation Street Live. Axel, thank you so much.
Thanks, Rich.
See you after the break.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IAG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IAG, the home of the ambitious.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
You can find a variety of asset classes on the sidebar menu to the left of your platform. It's now time to pick an asset class. There are 4 major types. 1. Shares in individual companies listed on global stock exchanges. 2. Indices, a group of shares measuring the performance of a particular region, exchange, or sector. 3. Forex, the value of one currency compared to another, like the pound versus the dollar. 4. Commodities, like gold, oil, natural gas, or wheat. Decide which of these markets interest you and which you know the most about. It's up to you to research the market you'd like to trade. This will help inform any trading decisions you make. You need to know the risk of trading a particular market. For example, some markets react to events like economic releases. Next, look at the market's opening hours and how they'll fit into your trading plan. The deal ticket will let you know if a market is open or closed. Lastly, look at the costs and charges applicable. Once you're happy with your market choice, place a deal through the deal ticket.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer 2 ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Hello, trading friends. I'm trying not to giggle because Caleb just said something naughty, like I'm strapping you. Trading experiences. Trading experiences is one of the hottest series here at IG, and we are joined by none other than James Gordon, Head
Hello
of
again.
Tax here at IG. Thank you so much for coming back again. I'm so pleased to see you because I was worried I'd scared you off, and after
Every time is scary. Promise. Keep coming back.
And I was so impressed by your keyboard. Everyone's been talking about that.
Of course, a bit of chatter, hasn't it?
Yes, it has. It has. Which then sparked off a trading psychologies segment with Issar. It has also sparked a huge number of our trader friends sharing the sort of music and techniques that they use to reset the mind.
Great.
Yeah.
If you find a thing that can reset your mind, that's a genius little tweak to your psychology. I mean, share them with me, please. I'm still looking for some of these good resets, but music is a good one for sure, and posture actually. I know Izza yesterday was talking about desk layout and stuff like that, but actually, if I dare to plug my old-fashioned blog again, there's a whole section on there about how you sit at your desk and how you have your chin up and stuff, and having your chin up, and that it boosts testosterone, which reduces cortisol, which again gets you out of the fight or flight mode. And this is all science. This is not me making this stuff up. Someone's put someone in a scanner and figured it all out. So yeah, there's some great TED Talks on posture to help your mood, which then helps your trading. And
prevents that chimp from taking over.
The chimp he's always there. Remember, the chimp is always there. So yes, everything to feed him, as it were, keep him happy.
Now, let's have a look at some of the charts that you've sent us. Just popping them up now, if I may. So talk us through this.
I've got to look over there, right? What have we got here?
This is the Germany, the DAX.
5 minutes, yeah. So this is going back to, so I was a technical trader, right? Super short term, very simple technical analysis in the sense of I was just looking for support and resistance levels and the breaks of those levels. In this case, the level is actually a pivot level, which I think I mentioned last week is this ludicrous mathematical level that gets printed on charts, and it works because everyone believes it works. It doesn't really work. There's no fundamental reason why it works, but it just does seem to work quite a lot. So yeah, my analysis here is I need to have the moving averages pointing in the right direction. So I had a bespoke indicator using MT4, which tweaked, that looked at the gradient of the moving averages. So there's two moving averages, a 34 EMA and a 14 SMA. If those lined up with the indicator, that said buy or sell. Then you look for the level to break. And then, before all this, obviously, you've planned this all ahead. This is not just me clicking at market. I've seen that level building. I've put my order in to trigger a stop entry order just below the level break. Get in, take your 10 pips, let a second contract run for some more pips. Simple as that. I don't know why it's so hard. Like, it sounds really easy, right?
Yes, it sounds very easy. I like your technique as well. It's like you're like the 10 pip Robin Hood.
Yeah, that's back to one of this whole, that gave me lots of small wins. And for my completely weak mental state, that was much better than running the kind of 3-to-1 thing where you have lots of small losses and then a big win. My brain...
I'm totally with you. I'm totally with you. I am small and often rather than big wins but big losses, and trying to get those big wins to more than offset the losses.
My worst days are always when I break out of that model and I go, oh, let's just go for the big home run today, or I've set my expectations too high. And then suddenly I say, I don't want 10 pips, I want 50 pips. Funny enough, 50 pips don't come along as often as 10 pips do. And most of the time your trade reverses back and knocks you out. So
this is where you can use the IG ATR function and have the average true range over whichever time frame you want, paired with the expected move on the Tasty platform to tell you whether it'll go up or down.
I need to learn this. Where have I been?
It's all on the show. All the Twitter friends have been watching this.
Contrary to popular belief, I actually do some work as well as watching the show. So I need to watch more show because I'm still doing tax, unfortunately.
Bigger Biaz saying between a good chair to improve posture and a Tidal subscription, you may be right.
Good money well spent, I would
Yes,
say. Yeah,
yes.
yeah.
He's also saying not going to trade today. Going with he. Looking at the picture, not feeling well. That's good. We talk about that's very, very responsible. We talk about optimized trading here, having guardrails, only trading when you're in optimum, right? Feeling good. You're feeling calm.
Yeah, perfect.
You're not. What
Really
is
good
it?
Self-awareness.
Yeah, as I was saying yesterday, you're not. There's a term for it that was sparked
Like
off
a flow state, or in the zone, or
yeah, or in poker they call it
on
tipper.
tilt.
On tilt,
Yeah,
because
yeah.
of the tilted. Thank you, Caleb, because of the pinball machine.
And it's worth being aware that that is the same. You get the same problems if you're feeling down and ill or whatever. You also have euphoria is also a killer of traders.
Yes.
My worst losses come after my best trades, because suddenly I'm a genius. And I'm like, and you literally can't perceive risk properly anymore. You think everything's easy. And funny enough, then you double up your size or triple up your size and it all goes wrong and you get blinded and you get caught in the headlights and you freeze and it all goes wrong. So I'm actually more wary of feeling euphoric from good trading, which then 3 weeks ago I had my best ever options trade, best ever trade in the history of my life. And I suddenly thought, oh, this is working out. And then I gave half of it back in the next 3 days because I was just like, oh yeah, quick, I'll do 0 day options and all that kind of stuff. Because I was euphoric.
Well, you know, we all have days like that, don't we? Let's go to the second chart now, which I'm bringing up here. This is the dollar versus the yen.
Yeah, so this again is another one which actually worked, which is always nice. Again, for some reason, the pivot is working on this one. Again, I've been disciplined. I've not entered until the level has broken. This is just before.
I remember I love it, that post-it note. Kill yourself if you
do the pre-entry breakout. It's very true. And the reason I got out of this one is because if you see, that was at 429, and that is just before the US cash market opens. And although this is an exchange rate, the US cash open can just create weird, random noise in any market. So this was book my, what was it, probably 15, 20 pips. And as it actually turned out, that was actually quite a good place to book it. So that is an example of a breakout trade going well. Moving averages are pointing down, levels broken, in, out, quick, go and have a beer or something.
Yeah. Lots of our trader friends sometimes hear me say things like, you know, if I've had a good run early on, I use this term which tickles some of our clients a lot, because we got Tiffany who understands Hokkien. I say "kam tiam," which just means I'm going to close the shop now, right? Had a good run, even if it's early in the morning. I'm just going to, like you, go for a beer, do something else.
I mean, I sometimes close the shop at 8 a.m. because I'd done a couple of good trades and I knew my euphoria would ruin the rest of the day. I only learned that from experience of ruining my days.
Pull you back in, and then before you know it, you kind of net. I hate those days when you've put in so much effort and then your net is zero.
Yeah. And I that happened to me so much. And when I read back through my trading journal, it's just like, you idiot. But it kind of, you learn that by experience.
Hearing it here first, trader friends, head of tax at IG saying, you idiot.
Yes, to me. But that's the way you, unfortunately, sometimes that's the best way to learn, is feeling their own pain. You know, you can hear me saying this, don't do it, but you probably will, because you're a human.
Do you often go back and look at your trades and think, oh my goodness, if only I had done it a different way and I had heeded my earlier instructions?
Like all the time. I look back at the charts and just think, what was I seeing? I cannot see what I was seeing at the time. Or very clearly, the chimp was in control and there's just mad stuff all over the chart and it doesn't make any sense at all. I think one of the ones on here, if we go further down, probably.
Yeah, so this is the DAX again.
So this is a good example of not paying attention to the rules, actually, yeah. So here I am, there's a line on the chart, there must have been some historic level there. I am going short, even though the moving averages are pointing very clearly upwards. And I've done it twice. I haven't done it once. Twice I've tried to go completely against the trend. What the hell was I doing? I have no idea. The only good thing about that chart is the stops are very, very tight. So I probably must have acknowledged that I was being stupid and therefore put a very tight stop on I'm sharing that just because it's slightly embarrassing, and it's just there's no reason to be entering trades into that.
No embarrassment here. You are in a safe space. We all share embarrassments. Caleb says this is not true. I am feeling the pain with my Diageo. Still feeling the pain with Diageo, although it's had a bit of a blip higher recently. And James, away from them, saying this is resonating so much with my own journey. Mine too. There's a lot of pain before you get good at something, right? A lot of falling off the bicycle, getting back again. Falling off the bicycle, getting back on again.
Yeah, and just to keep doing it's all about, in the first years, it's about process, not result, right? So if you follow your rules, enter the trade, doesn't matter what the result of the trade is, did you follow the process which you have designed to have some kind of probability of success? Just keep repeating that. There's a great book actually called One Good Trade by a guy in New York who runs this kind of a prop shop. And it's just about one good trade. Just do one good trade. Whatever happened in the trade before is relevant to your next trade. So just keep doing the process. Keep doing the process. Let the money look after itself.
Yeah.
But the trouble for that is you need a lot of time, probably years. And so you have to stick with it. But it works.
Is this the one that you're talking about? One Good Trade, blue cover here.
Mike
Wiley Trading.
Yes, it probably. Yes, that looks like it. Yeah, I mean that's now. I mean, I read that 10 years ago probably, but it's still totally valid. Good. There's a bit of psychology in there, a bit of technique, and it's just this process. It's all about process. Forget the numbers. They look after themselves.
We have to wrap up really quickly now, but before we go, just wanted to get you to kind of give us an insight to what is coming up in your next session with us.
Where are we at now? Probably is that going to be number 6? Probably. I'm open to ideas actually. Throw some ideas out there. But
yeah, trader friends, lots of you there with lots of questions. Maturin talking about the benefit of a journal. Adam DeLuz talking a lot about also that book. He says a lot of senior traders recommend that book. Technicals. A lot of our trader friends here use technicals alongside whatever technique they're using.
Yeah.
I would say that this really resonates with me because did you find that at the beginning of your journey, a lot of it is also capital preservation?
100%. Your primary job as a starting out trader is to preserve your capital. But you have to be in the game. If you're not in the game, if you haven't got any capital, you're not in the game. So manage your risk. Put the stops in the right. We should do a session on where the stop should actually be placed.
That's a good one.
Not where your account can afford the stop to be. Where the stop should actually be per the chart. And if you can't afford it, you shouldn't be in the trade.
And on that note, we have to finish off there, but do join us next Thursday, where we will be answering all your questions to James Gordon and talking about how to preserve capital. Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Welcome to another episode of Talking Shop with IG. This is a new one for us. We're simultaneously going out live on Trade Live with IG, and it's going to be recorded for a podcast. So, a merging of the worlds. And I'm joined by my glamorous assistants, Pete Ward.
Hello.
And Ronnie. Ronnie Agling is back.
Back again. Another substitution.
Back once again with the Renegade Master, right?
Exactly.
Pete, you're back. You weren't with us a couple of weeks ago. Where were you?
That was late shift, I think it was. I was seeing a client. That was it.
Oh yeah. One of those.
Clients first, you know that.
Clients first.
Champion them. That's it.
We've got to champion the clients.
But yeah, Ronnie did a great job, so I've come back to fight for my seat.
I've got to keep my spot. Sean's out.
Sean's out. Sean's on the late shift today. We've got to keep this. We're keeping this rolling, right? So we're keeping a rolling crowd of people that are going out, carving their careers on Trade Live with IG, and then you move into the fast lane. Then you come into Talking Shop, and we're going to be here each week.
Exactly. This is the A team.
This is the A team. So, what are we talking about this week? This week, it's all about the trading plan. We're continuing our Tradecraft series. We're here to not tell you, what markets are the most interesting or what setups to use and all this kind of stuff. What we're here to do is to say, how do we act with intent? So when you are trading, how can we give you the tools to help you succeed? And this week, it's all about trading with a plan, trading with purpose. So I'll kick us off just with a quick definition. We actually used these guys last week, but the Corporate Finance Institute defines a trading plan as a systematic approach used to identify and trade securities based on several variables, such as investment objectives, risks, and time. A trading plan lays out your procedures and conditions for which to search for asset classes and execute trades. And kind of with that bubble, we know trading is, and having a plan is more than just trading with a hunch. Right? You can't look at something if you haven't done some form of research. And so what I want to just kind of use to introduce this discussion is what are some of the essential elements that you see in a trading plan? What does a trading plan mean to you both?
Yeah, for me personally, it's like you said, not trading on a hunch, having a systematic approach to it. So always try to define my entries and my exits before I actually go into it, and make sure that I know what I'm trading. So I'm not like a dog chasing its own tail, running after the next trend and see what's ever moving. So being systematic and having the criteria that I select when I trade.
Yeah, interesting. I think I've tried a number of different things, I think, over the years in terms of a trading plan, whether that's like a numeric target, and whether it's a percentage amount. But I think what you try to refine, I guess, over time is a clear, like you say, clear entry. And discipline, basically. Trying to put that discipline in place where you don't repeat certain mistakes of the past. Main one being don't average in. That's the kind of one that I try to keep at the forefront of my mind. I think there's a great slogan. One of my clients told me about this. He said that he used to work for Paul Tudor Jones.
Oh yeah.
And he said that in his office he had a big slogan above his desk, which is losers average losers. And he's like, if you remember that, you won't go far wrong. And to be fair, it's kind of correct. So I think having that in my plan is definitely part of it. And then a clear level at which you go, right, okay, it's done what I wanted it to do. I'm never going to get at the top, I'm never going to get at the bottom. Let's take something out of the journey and then exit.
Yeah, I think for me, it's about being intentional. I've had runs in the past where I know that I'm punting. And that's fine, I think, if you live in that kind of sporting world and you want to use this as a way to express just a view. But I think as you become more of an accomplished trader, you need to sit there and you need to have intent. And so I haven't yet found success in terms of making a specific target, because I worry that if you don't hit it, it then gives you more problems down the road when you're starting to chase a specific goal, like a specific financial amount or a specific number of points. Ambition can almost be a trader's worst enemy.
Yeah, you can definitely add more pressure to yourself, right? If you go, right, okay, I need to make 500 quid a week, and let's say you're at 300 or whatever, but there's no setup and it's Friday afternoon, chances are you go in, you're probably going to lose that 300.
Yeah, that's when you're taking those unnecessary risks that you don't want to.
Yeah, but if you've got that pressure on yourself to say, well, I need to finish the week and close the laptop and say that I've banked the 500, you're going to go back in. So I think a trading plan is helpful in those sorts of scenarios, as long as you're not too married to a financial amount. I think we've touched on it before in this series of kind of risk management, and we're talking about loss prevention, and we're talking about the capital protection, as opposed to trying to make money. We're trying to not lose money, right?
Exactly, that's the most important thing.
So I think that's important.
Yeah, for me, I think trading is one of those slightly weird ventures. If you needed to be qualified to go and do something in any other walk of life, you've got to sit a test, right? Driving test. For us, you walk in the front door, we're going to ask you to go through a series. We're doing it with some of the guys that have just joined the team now.
Yeah.
We're going to simulate a bunch of phone calls with clients. If you wanted to go on the Trade Live with IG show, we're going to do some dry runs with you before.
Yeah.
Most ventures that are valuable require you to do some kind of qualification or some kind of test beforehand, but trading doesn't, right? You open the account. We used to have a kind of a coach here that helped us out with some training. And he said, right, here's your badge, here's your gun, you're the sheriff now, right?
Yeah.
And it doesn't really work like that when you're going to go and blindly take a leverage position in something you don't really know about.
Yeah, that's when you end up paying your tuitions to the markets.
Yeah, that's it. Yeah, it could be an expensive private school. Right?
Yeah, very much so.
But yeah, I mean, I think, and that's the key differential in what we do here, I guess, with the leverage side of the business, on the spread betting and the CFDs, is people can come to trading, and if they come to it in the form of share dealing or ISA share dealing or whatever that might be, you might have the view that you go, right, okay, well, I want to buy this stock, and if it doesn't go too well, I'm going to own it until it does go well, right? So then you can go, right, this is a long-term thing, and your trading plan then is really wait for it to go up.
Yeah.
Whereas if you're trading on leverage on an intraday, intra-week basis, you can't have that mindset. You've got to go, right, I'm going in because of this reason, and if it goes wrong, I'm coming out here, and if it goes right, then I'm either going to go with it or I'm going to come out at a certain point.
Yeah.
You've got to actively manage it, and I think that's the key differential.
I think so. I think that's the key difference for me in terms of trading and investing. Trading is, I've got an idea, I'm going to put it on, I've got very clear criteria about when this trade is coming off. And for me, it's not a time thing, it's if this stop is triggered or if my target gets met, for whatever reason, that's basically forming the best part of my plan. What I haven't added, just because we are in this new fancy world of live, if you do have any questions, we are streaming this on the platform in real time, also on YouTube. So we're piggybacking on the Trade Live with IG tech. If there's any questions, we're going to try and catch them at the end. So we're aiming to be on until about 10:30. So if you've got any questions at all to put to the guys, pop them in the chat and let us know. To move into the kind of nuts and bolts of this question then, I've seen people get bogged down in analysis paralysis, where there's just too many things to read. If a new client comes up to me and says, what's a strategy? There's countless. So what would you say as some advice to someone who's trying to find that sweet spot between research and actually pulling the trigger? So what do you need as a fundamental? What are the couple of things that you need fundamentally to be ready in order to then be confident to take a trade?
Yeah, so one thing that I often do is sort of, like you said, there's a difference between investing and trading. So when you're trading, you have to keep in mind that you're trading on a shorter sort of horizon. So I always I like to follow the news to see what's actually going to happen. Based on that, what I read, what's happened, I make a decision. Right, this has happened, this is what I think will happen. And then after that, once I have that sort of criteria, I then go on the chart, see where it's trading, and then from there find, okay, we ended here, I think because of X, Y, and Z that happened yesterday, I think we're gonna end up here. If I'm wrong, I have my exit level here because I'd rather minimize my loss than, let it run and come back around, because if you let it run forever, you're just going to end up losing your account to overnight funding.
Humans are the lowest edge in this game, I think, because of emotion. Because of emotion, because of ambition. So you've got to be rules-based, you've got to be either fundamental-based, and then you've got to look at things like, okay, is this a mean reverting strategy, or is this a breakout strategy, or is this a buy-the-dip type of long-term investment?
Yeah.
It isn't, unfortunately, Lambos and get-rich-quick TikToks. No. It's definitely not the case.
Yeah, you've got to do some degree of work, right? But you also need to act, and I think that's a problem that a lot of people face when they start trading, is that they are almost too hesitant to get into the market, and they want to stick around maybe watching what could have happened, paper trading, demo trading, all that sort of stuff, which I think is important for a little bit, as long as you set yourself a time where you go, right, okay, now it's time to actually put something into the market. Because if you don't act, you don't get the actual live feeling of trading and having that risk on. It's like, you play poker for no money, on a demo account, you're going to go in on every single hand, right?
Yeah.
Whereas if you're trading and you've got actual, it doesn't need to be a lot, but actual skin in the game, all of a sudden you're live and it's real. So I used to work with a guy, and he used to say, it was quite a good kind of analogy, if a little bit salesy, but he used to say, like, if you want to be a Formula One race car driver, You can't sit on a PS5 all day long playing. You've got to get in the car, right? You've got to feel it. You've got to feel that. And it's the same with the trading. So I think you've got to do your research, have a read around what you want to do. Maybe stick to, when you're starting out, just 1 or 2 markets. Don't try and, do 20 different things and cross correlations and trading yen against commodities and all this sort of stuff. Just stick to a couple of different things, maybe 2, maybe 3 markets. Get to know the price action on those markets. Get to know the natural prices, where things should be. And then when you're ready with this trade setup, just give it a go in small with a stop.
Yeah, I think our trade of the week product that we've got that Axel runs is if you don't want to use it as a way to trade, that's fine. But I think using it as a tool to understand the thought process behind someone who's managed money, behind someone who is incredibly technically focused, Axel will use a 1% of his account stop every time. That's it. That is the rule, and he'll have no more than 3% of his account at risk at any one time. That in itself, just those restrictive guidelines, if you're honest with yourself, most people break those types of rules.
Yeah, and that is a trading plan, isn't it?
That is exactly a trading plan. Yeah. And you can run the numbers, and there's plenty of assets on our website where you could look at, they've run, Axel with his trading coach did a simulation of 100 trades, 20,000 times. So we ran this kind of Monte Carlo simulation again and again and again. And he was looking at trying to test different risk versus reward levels. I think we mentioned it in the maths episode. But I was talking to a client about it yesterday. On a 50% hit rate strategy, which I would say is still pretty quite good, there is a 100% chance that you're going to lose 5 trades in a row at some point.
100% chance.
Yeah, there's over 20,000 simulations. Yeah, so there's a 100% chance on a coin flip, 50-50, you're going to lose 5 in a row. Now, if you're risking 20% of your account, that's your account gone.
Yeah.
So if you're risking 1% of your account every single time, that's 5% of your account gone. It's impossible, therefore, if you're trying to keep this to 3% max risk cap, you can't lose more than 3% because you're going to get stopped out by your system. That in itself is you can be fundamentally based. You can say, right, I'm buying BT because of the double downgrade. I want to buy the dip. You could be looking at BP because you want to follow Elliott management into the trade. But if it drops down 1%, you're out, and that's it. And you let the system drive it for you.
Yeah, 100%. That's sort of an important factor that, like we said, you have your predetermined stop levels, but also for me, myself, I know that I've traded both demo and I've traded on the live, and I get some shtick for trading on the demo, but when I trading compared the two, like the emotions that are running in between, like for me when I'm trading on the live compared to the demo, when I'm on the demo, ice in my veins, I hold the positions, whatever.
Well, because it doesn't matter, right?
Exactly, it doesn't matter, just monopoly money. But when it's my real hard-earned money, I know how many client calls I've answered to make this money and trade it. I'm way more careful with it. And like you said, looking at Axel, you don't have to be a pro. You don't have to spend 30 years doing whatever Axel did, but taking advantage from someone who has and following that, or adopting it and doing it your own sense, I think that's a really good one. When you can take from others and sort of implement your own criteria and rules, that's where you can build up your own strategy and not following someone blindly, but taking inspiration from them.
Yeah. What do you know? One of the things we're looking at a bit more at the moment, and I know you've been looking at it with the Tasty product, is trying to use mathematical expectations to set your stops and your limits. So one of the things I've been talking to a few of my guys about is Tasty, you can look at time periods. So you can look at the weekly and the monthly series of options, and granted this is going to be US stocks, it's going to be US traded futures, but you'll get most of the macro indices over there and FX trades. Using the option construct, it will give you an expectation of what the price move could be in that time period.
Right.
That then, the odds of the market trading at that level. Now, of course, fundamentals can change, right? The C can change, the volatility can change, CPI could come out and the world, drops 5-6% overnight.
Yeah.
But using mathematical expectations and probabilities to start setting your stops, we're starting to get a bit more advanced here, but that feels like a way where, instead of just putting stops on a whim, feels a bit of an easier way for people to start to translate, to say, well, that's where the market is currently pricing it could or couldn't go. Think about it.
Yeah. I mean, you can use those. You can could dive into, like you say on Tasty, you can look at percentage of getting there, or look at the delta of something and see the likelihood of that actually occurring, and then place your stops. Or you could just go basic support resistance.
Yeah.
Where are the stress points in the market? Where should I typically be? If you're going to trade, an index, then look at what the daily range is on that index, and then plan accordingly.
That's what I hear.
There's no point trading the FTSE with a 5-point stop. Like you're going to get knocked out, even if it goes right in your direction. It's going to gyrate a little bit because that's what it does, right? So, I think looking at it in terms of, where has been the recent high, where has been the recent low, where is the sort of the support, where is the resistance, and then just putting your stops kind of just around those levels, really.
Yeah, but how many times have you heard the market makers are out to get me,
Yeah.
or they are the big boys, all this kind of stuff? Support and resistance. I've always struggled with support and resistance just on a basic level, because the chart is the chart, right? Every person looking at that market is looking at exactly the same level that you're looking at, and they're going to say, okay, there's going to be a high here. I'm going to put my stop a couple of ticks above the high. And then that goes. Or you're going to say, put it a couple of ticks below the low. And it will always happen that the market reverses, because it's just, we're so biased and we're so kind of stuck in this loss aversion type of mentality that as soon as you put a stop loss, you go, right, I'm stopped out. Oh, and the market reverses in my face, right? That's just the most frustrating thing.
I mean, it's sort of like, but the clients getting stopped out, or you getting stopped out. I had one session with Axel and a client, and the client said, I never put stop losses. I did it once and I just got stopped out right away. Well, then Axel said that, if you put the stop loss just underneath or too close, of course you're going to get stopped out. There's nothing wrong with having a stop loss a bit further away. Just allow yourself with some breathing room, and everything's not going to go exactly continue with the chart. That's just not how it works. So give yourself some breathing room and allow yourself to take those swings, but have a bottom, like a floor.
Yeah, I think I can see we've got some questions on stops. So we'll come back to some more of these specific ones at the end. And this is going to form part of our Tradecraft series. I think we're going to do a whole episode on stops. I think it just, having a whole episode on closing conditions, I think is really, really important. But to kind of continue the conversation just around plans, what's your take on a trading journal?
I've heard about and I've seen a trading journal. Personally, I think it's a good idea. I just don't know if it's realistic. If you're trading actively, i.e., maybe 10, 20 times a day, are you going to journal and document all of those trades? But then I was, we were talking about this the other day. I was saying, if you were trading pretty much exclusively trading your own money as your job almost, you could build it into your daily structure. So if you're on the screen, from UK Open until after, I don't know, US Open, and then you do the UK close, you could put in 40 minutes at the end of the day to say, right, let's go through what I've done and what's worked and what hasn't. And I think it'd be a valuable thing to do. It's just whether or not it's realistic.
How many people do you reckon that are trading 20 times a day are genuinely doing it proprofitably?
I think it's very few people.
Small, right?
Yeah.
Because then if you're going to be that active, it helps keep the lights on at all your brokerage accounts. Fantastic, thank you very much. But you're paying a lot of spread away, so that's going to eat into your profits every single time. And it's not. It's you start to think about, are we playing this game in the most efficient way? Well, probably not. If you were to swing a position, we have a guy that calls us.
Speak to day traders and they go, well, I'm not paying anything overnight then because I'm done, and I shut the laptop for the day. And you go, yeah, I get that. I do hear that.
Yeah, but effectively, if you're trading 20 times a day, you're effectively scalping, right? Like some sort
more
of
than
scalping.
likely, yeah, scalping index.
Yeah, you're effectively scalping, and then you're just taking these tiny wins, which is great, until you get a massive loss, and all of your 1 month of profits are eaten up.
But then if you've not got discipline.
If you've not got discipline, right? And position sizing also comes into this. Position sizing is so key. If you're risking 1% of your account, and this we will go into in another episode, because in fact, it's going to be next week. I've already planned it, so sneak peek, position sizing next week. But if you set a stop distance first, okay, because you've got to take the view that if you're going to drive the car, you're going to go out with insurance, okay, because otherwise, the unthinkable could happen. You put a stop that's 10 points away and you're trying to risk 1% of your account. Your position size is then driven by 10 points divided by 1% of your account. That's where you get your position size from.
Yeah.
And of course, if you then continue to think about this in an optimal way, if you make 5 losses, you've lost 5% of your account. Well, your account is now worth 95%. So your optimal position sizing now needs to be lower.
Yeah.
So
Yeah.
that the idea is you're constantly capital preserving each time. And it works both ways as well. So the idea is that you dial up your size when you're growing. Otherwise, you're never going to make exponential returns. You're never going to make this a fruitful discussion. So look, to kind of, what are the nuts and bolts of a trading plan? Being rules-based or being technical or being discretionary, that's all okay, but be very specific about how you manage risk. I would say be very specific about your entry and exit criteria. Risk management, so using stops, optimal position sizing, knowing where your risk reward is, these things are all super, super key. And a trading journal, look, if you're trading once or twice a day, I think it works. I think you don't have to write, War and Peace, but you just need to be honest with yourself and say, I've entered because of this reason, I've left because of this reason. My setup that I'm choosing is I've seen 3 green candles and I'm below the RSI and I'm breaking above a MAC, whatever it is. You then, I genuinely think if you were to document 100 trades and you were just testing different things, right, and you're jumping between strategies or you're jumping between setups, do it in tiny size. You've then got a database that you can then query your own trades and say, well, actually, trading gold at 3 in the mornings, that's out straight away because I've tested that hypothesis and that doesn't work, gone. And you've then got that database to refer back to.
Yeah.
And it comes with experience.
What columns would you have in your trading plan then if you were going to journal it?
For me, entry, reason, why, so my setup, opening level, closing level, reason for closing. And then the one thing I'm not good at is having some form of confidence level in it. Because you can go in and you say, right, I'm really confident on this trade, ranked, and Axel does it really, really well. He ranks his emotions and he ranks his confidence levels. So is he tired, right? And he got so granular because he's traded for 30 years that he knows that if he's tired or if he's had an argument at home or that the kids have kept him up all night or that he's got a difficult meeting to deal with at work, those things create low edge environments for him. But you don't know that until you've back tested it in theory by having a bit of a note on what you're doing.
Yeah, I think the most important thing is it's all great taking notes and having 100 columns, but the most important thing is that you actually look back, read them, and then take that into consideration, and don't hit yourself with the most dangerous word in the world, the most dangerous words in the world of finance, which is this time it'll be different. So yeah, follow your actual rules and take learning from that.
Boring though, right?
Yeah, but then I always say you've got to kind of make trading a little bit boring, right? I know that everyone wants to sort of rock and roll, let's hit a home run on every trade.
Yeah.
But realistically, you've got to make it a system that works for you more than X amount of the time, and that makes you money over the course of a year or a month or whatever it is that you want to try and do it at. But having, as soon as you engage with risk reward ratios, stop and a limit, and a percentage of your account as your size, that is pretty much a trading plan straight away there. And if you stick with that, it will make it a little bit more boring, but it'll probably make it a bit more, you give more longevity to it.
I have a historic example of what happens when you don't follow what happens when you follow your trading rules and when you don't follow them. So are you guys familiar with the historic trader Jesse Livermore?
Yeah.
The Confessions of a Stock Operator.
Yeah. So he made over 100 million by shorting the stock market because he had his clear-cut rules that he always followed. However, success went to his head, and as Bill Gates says, success is a lousy teacher. So success went to his head, he ignored his own trading rules and over-leveraged and took on more risk than he actually should have done, and he lost everything.
Well, in the words of the great Mike Tyson, right? Everyone's got a plan so they get punched in the face.
Yeah.
And then all of a sudden you're playing defense.
Yeah, and stay humble, Stay humble, eh? Like, just because you are on a great run doesn't mean you'll continue forever, and don't stray away from what brought you success.
Yeah, well, that's one of the best things to learn, isn't it? Is that the market will always humble you at some point and give you a slap, no matter who you are.
Yeah.
So yeah, the minute you get cocky, the minute you get right, okay, this is really working for me, I'm going to triple up my size, or I've had three great weeks, I can afford to YOLO it all into my final week, will invariably give it back as soon as you break that model. So discipline, like we've said from the start, is the key. And I think you can't sit here and say things like, right, never average down, because people will average down, right?
Yeah.
So then you go, right, well, how do you frame that so that you can do it, but do it within a bit more of a confined space? You could say, right, okay, well, I want my overall position size to be X, and I'm going to clip in.
In 1/10 of
And I'm
X.
going to clip in and I'm going to do 10 clips if it goes to this bit. But then I know that that's the limited size of my position.
Yeah.
Okay. And then you've got a more realistic area where you go, okay, yeah, no, I liked it there. And I still like it, but it's a bit cheaper, so I'll grab a little bit more. But I'm not going to do the same size as my max size 10 times and end up catching a piano, basically.
Yeah.
So I think that's important. You know, we sit here and we're talking about trading, and you've got to be realistic that the book says this, but realistically, humans will do something slightly different. They will flex that, right?
Yeah.
And I think that's fine as long as you keep your notional size under wraps and under control.
Well, think
Because
about it.
you do get blown up, especially on leverage. You can do that, like you say, you can do the scalping side of things, you can do the swing trading. But as soon as you get too big, you can get caught out.
Well, let's think about it, right? What to kind of move the conversation on then. So we've spoken about what a plan is and how it can be very simply defined, and then how you can kind of start to think about that. The other side of this is, what do you define success as, right? If you're sitting there as an ambitious new trader and you're trying to say, right, I want to open a trading account, what does success look like? We have a question about setting goals and should we aim for an amount per week, per month?
Yeah.
What's your take?
In my opinion, if you don't lose money, you're doing brilliantly. I mean, it's like Warren Buffett said, first rule of investing is don't lose money. Second rule is never forget rule number one. I think just not losing money is a great start for a new trader, a new beginner coming in. As long as your account doesn't shrink, I think you're doing something well, because historically we look, majority of people lose money. So establishing a plan that allows you to maybe grow it a tiny bit or whatever is fine, but just try not to lose money and you'll be golden.
Yeah, I like to kind of, rather than setting a numeric target, I think it's good to keep an account size. And so if you're, happy playing with a 20 grand account, and let's say you have a particularly good week and it takes up to 24, take the 4 away and start the next week with the same size.
Yeah.
Instead of trying to go, right, okay, well now I've got 20% more, I'm now going to do bigger trades, and then all of a sudden you do 5 wrong trades in a row, you're down to 10 grand and you busted half your account.
Yeah.
So yeah, that sort of idea of keeping the book size the same, if you can, and just, try and farm off some money.
Yeah, makes sense. For me, it's trading's part of a portfolio. So I keep my passive kind of market-based investing in my ISA, in my pension. So I'm long the market naturally through some ETFs, through some investment trusts and some individual stocks, right? That's that. Trading is a game to see if I can make some money, and the market's going to reward you or it's not. So I actually think setting an amount of money on it is quite dangerous, because if you say you want to make 200 quid a day, right, and we know that you can break the statistics down, even on a 1% risk, you can lose 3 trades in a row pretty quickly, so you've lost 3% of your account, right? If you've defined the sizes such that that isn't a material amount of capital to your overall wealth, you're not going to go on that psychological tilt. But what you are going to do is you're victim to your own ambition.
Yeah.
Because you're now saying, well, I said to myself, I'm going to make 200 quid. My plan says I'm going to make 200 quid. Now you're chasing. So even with the best laid plans, if you start to then think about a fixed amount of money, I think you can really fall into it. For me, it's about the process. If I can sit there and say, this week I've traded with 1% risk, I've genuinely optimized my position sizing. If I've lost money, I've lost money. It's just the market, right? You can make money on a 30% hit rate strategy. You can make money on a 20% hit rate strategy if you manage risk properly. But if I've followed my rules and I've not been rewarded for that, so be it.
Yeah.
My question is, how strict should one be with the rules? Like, should you never stray away, allow some flexibility, or should you always stick to your rules, in your opinion?
For me, I still think the human is the weakest part of any trading strategy.
Yeah.
I think we can lean into the maths. Trading is about maths at the end of the day. It's about, percentages. It's about managing an amount of risk. If you change that, not saying you have to change everything, but let's say you've got a setup that you're looking at on the FTSE. Okay? That doesn't mean it's going to automatically apply to the DAX or the euro dollar, right? You can have different tools for different fights. So what you're saying is, when do you choose to say, actually, my plan's crap.
Yeah.
This is not a good plan. And maybe that comes after, I don't know, if you've lost 10 in a row and you've now lost 10% of your account, you've got to size down.
Yeah.
Maybe you start to draw some fail safes into it. I use the comparison to a banker or kind of what everyone would define as like a professional trader, someone sat on a prop floor. The reason why these guys are typically more successful than retail traders is because they've got a risk manager on their shoulder. They've got compliance. They've got a flow dealing desk that says how much risk they're allowed to take.
Yeah.
You know, quite often if you lose 10 trades, 5 trades in a row, you're done for the day. See ya.
Yeah.
Go home.
Yeah, sort of take back, relax. So I guess the room for flexibility is sort of flexibility in changing the plan and not just pushing out the edges of what you're allowed to do within the plan. Because, you know, as we know, just having a plan, that's a great start, but it needs to be a good plan that works as well. So at a certain point, you have to sort of reconsider, okay, what am I doing wrong here?
Completely. What do you reckon, just before we move on to the next section about how we stick to it, what do you reckon the textbooks, I had a quick look through kind of the internet last night. Perplexity was my boy. Just got it all to do it for me. What do you reckon the most widely accepted kind of wisdom is on how long it takes to become a professional, to become a profitable trader, excuse me?
What, in terms of time?
Yeah.
Does it feed into the 10,000 hours mantra?
That's what I was thinking.
That's generally the benchmark.
But they reckon about a year.
About a year.
About a year.
Yeah. I think you've got to experience a significant loss to get that not knee jerk, but that sort of kick in the behind to basically take it seriously and look at it and go, okay, right, that was too big, or that was too cavalier, or I wasn't looking on the screens, or I was doing something when I wasn't going to be monitoring it. I didn't have any risk management in process. I had a way bigger my trade was way too big for my size of my account. And then from that point on, you then go, right, this is something I really need to pay attention to. And I think, yeah, you're probably right, a year, probably longer.
Yeah, I think so.
Yeah,
I think so.
100%.
Especially if you want to learn all the different tools. You know, there's trading with a stop, there's trading with guaranteed stops, there's using limits, there's averaging into a position, trading on stop, buying with the trend, higher up prices, you know, I want to get into this, I want to be long. You know, if you did on the FTSE from Christmas, for example, 8100, you go, right, okay, I want to be long this. You could go, right, well, I'll put my initial piece in, and then you go, right, well, if it breaks through 82.80, then I think it's going to keep shooting. So you put an order to buy even more on stop. And then, you know, again and again, and you can look at the technical and go, if this all clicks in, it's great. Yeah, I'm paying higher prices than what I could be paying here, but I'm going with the trend.
Yeah.
And that's one way that people, you know, learn how to do it. And then obviously we've got all the option stuff.
Yeah.
You know, do you all of a sudden start putting covered strategies together? I think, yeah, it takes years, I would say, to get to the point where you go, right, I know all of the different tools that I've got in my arsenal, and I know how to use them and when to deploy them. And if you can do all of that, then I think you can say you got it as a professional.
Yeah, I mean, Donald, you've mentioned there on the chat, building into positions, completely agree with you, right? What we're talking about here is using position sizing as your plan. So if you're going to average into a position, be super strict to say, I'm not going to average down, losers average losers, but if you've got a target position size in mind, maybe build into that across an average period. If the market then moves in your favor, your optimum goal should be, I need to get that stop to break even as quickly as possible.
Yeah.
And if I then average up, I've still got to be super strict on my overall portfolio risk rules, because I know that I'm now adding risk into my portfolio. I've got to be super strict with that. But we're all human, and I think the point on all of this is, you're not working for a bank.
No, it's personal trading, isn't it?
Personal trading is to be personal to you. You know, you can't control if the kids are going to have complete fit overnight, and all of a sudden you can't keep an eye on things. And so that's why you've got to be super on top of stops and limits. More so for retail traders than anybody else. I want to move on just to talk about like the most common pitfalls. So of course, not having a plan.
Yeah.
Super low edge.
No plan, no exit strategy.
Yeah.
And no real handle on your notional size, or just a complete miscommunication between what you think you're doing and what you're actually doing. You know, what size am I actually swinging in the market? You know, you might think, oh, okay, well, I did 10 quid of FTSE, so therefore I'll do 10 quid a Dow. Well, you know, as we know, the FTSE's a 4-figure number, the Wall Street's a 5-figure number. All of a sudden, you've got huge different notional sizes.
Yeah.
So a 1% move in one is very different to a 1% move in the other. So it's getting that just that your mind around, right, what size am I actually controlling in the market? If I've got a 100 grand ticket and there's a 5% move, I know that I could make or lose 5 grand, and I'm okay with that.
Yeah.
I can go to sleep, and I'm going to sleep well. I'm not going to be up all night checking my phone and all this sort of stuff. But if you've got a 100 grand position in, and you're not ready to take a 5% or 10% move, you're only thinking of the upside. You're not thinking of the downside.
Yeah.
You're going to be stressed out. You're going to be chasing your tail. You're going to be over trading.
You get taxed on your ambition at that point.
Yeah.
If you've not controlled it.
Yeah.
If you've not set that stop. I had a conversation with a guy yesterday. He's been a prop trader for years. November had a great month at the start of the month. Got ahead of himself. Gave it all back. Started the account in December. Did even better, but ended December even worse than when he started. And the whole conversation was about, what have I done wrong? And it was about position sizing, ultimately. But we've done some studies on the most common mistakes that our clients make. Number one is over leveraging, right? Over leveraging, risking far too much. What you said, Paul. Pete, sorry. Not having an edge, not being able to sit there and say this particular mathematical structure that I'm putting in place actually pays me over time. And you can use backtesting, you can use different systems to have a look at that. Not using a stop loss, the third most common. Hopefully, the more you listen to us, the more you watch Trade Live with IG, hopefully this gets drummed in that stops are actually a good thing. They're there to protect you. And averaging into losers. Losers average losers is so key.
Yeah.
Who was it that said that?
Paul Tudor Jones.
Paul Tudor Jones.
But that's the thing about stops is something that I've taken on more recently in my personal trading now as well, is the fact that you've got Axel, who's a 30-year expert who lives and dies by the stops. Don't move the stop, put the stop on, let the stop do what it's meant to do.
Yeah.
If it goes, okay, well, it's not the end of the world. It's actually could have saved me another 100, 200 points. And if I still really love it, you can always have a look at it down there.
Well, no, if you necessarily love it, that's dangerous. If it sets up again.
Yeah.
If your entry conditions are met and you have another look at it.
And then you still want to go, then you've saved yourself that gap.
Yeah.
And I think that's important. And a lot of clients that we speak to, obviously, we're dealing with sort of premium end of the funnel. These typically high funded, high net worth individuals who might be, running their own companies and be, chief execs of this and be the master of what they do. But when it comes to the conversations about their account, they can sometimes come to it with that mindset of, well, I don't need to stop because I'll just buy more. I'm like, well, yeah, you probably can, but do you actually really want to be doing that? Or would you rather have a more measured position where you go, right, okay, yeah, I'm in the trade because of these reasons, and I've got to stop on. And it's trying to have that conversation of going, stops aren't just something that a new trader needs to use. They're something that you need to use in all of your trades.
Yeah, effectively moving your stop loss is effectively as bad as not having a stop loss at all. I mean, you move it once and then you continue to move it. Oh no, it's gonna turn. I don't want it to hit before it bounces back. I'm gonna look like a schmuck then. No, you look like a schmuck when you move your stop loss and it just continues to go down even further.
Yeah, the one thing I'd recommend, and this is something that as we learn the new Tasty tool that it gives, what Tasty will allow you to do is it looks at options, a scenario. I see we've got a comment about, this is the reason why we trade options. You can have a stop level, you could have a put with a particular strike price. If the market goes lower than it, your put is now going to be increasing in value to offset the losses on your directional play. So your delta is the change in your account value is zero, in theory, if you build it properly. But then if the market then goes back in your favor, the put's going to go back to zero and you're still in the position. So there's an interesting thing to do there. But what it will do, what Tasty will allow you to do is it allows you to build that trade, and then it gives you a probability of profit. And it gives you a chance, a mathematical chance on this trade is a 70% likely, it's 70% likely that it's going to hit it. Now you might make less, but you've got a high probability trade. And that's the whole kind of mantra. And I think once you start to think about things as odds, I think once you start to think about things as calculated risks, the rest of it just clicks into gear. That we're all just little kind of we're all just swimming around in this sea, all trying to make a little bit of money for ourselves. And you're right, Jugger, as you just mentioned on the comment, no loss is as cheap as the first loss. You're completely right with that one.
Yeah, definitely agree. And Paul Tudor Jones, who actually have some on my notes here, he never risked more than 1% of his trading. Never risked 1% of his to preserve his capital, and his hedge fund has returned over 200% over the time period it's operating. I mean, that's brilliant, 200%.
Well, Trade of the Week did, I think, 36% last year.
Yeah.
Risking 1% per position, no more than 3%.
Yeah.
And it's amazing. There's an article on the website when you look at the Trade of the Week section, and Axel does the Talking Technically slot on TV now, IGTV. Trade Live with IG. Set in my old ways, Trade Live with IG. And it's amazing the payout chart. If you were to look at your own trade analysis on the website, on the platform, I imagine most people will see big green bars and big red bars. So sometimes when you've realised big profits, but also unfortunately times you've realised big losses. The Trade Live with IG payout chart is fascinating because there's big green bars and lots of very fixed size red bars. And you know that mathematically it's the losses will be taken care of in the profits because that's just how it's set up.
And he's running a ratio, say 1 to 3. So he's losing 1, getting 3 if it goes right.
Yeah.
And so the ones that are going right are massively overpaying for the ones that have gone wrong, right?
Yeah.
And it's interesting with the Trade of the Week stuff, because when I looked at it, I thought, these stops are pretty wide in my mind. But actually, with the markets that they're trading, the moves do occur in those sorts of sizes over a week or 2 weeks.
Yeah.
Whereas I think we all get a little bit tunnel vision and go, okay, well, that seems like a massive stop. Like you need a much tighter than that and you can do a much bigger size.
Yeah.
And therefore you can potentially make a lot more, but you get stopped out.
Yeah.
You get stopped out and lose the money, right? So I think that 1%, just to sort of clarify, I think it's not 1% movement in the product, it's 1% of your capital.
Correct.
That you are allocating if it gets stopped out. So then you work out how much you want to do and where your stop needs to be.
Yeah. Well, we're going to talk about position sizing in a fortnight's time. I think that's that topic and actually physically how we set stops. You know, what do you keep an eye on to set stops? I think those two are the biggest topics that we're going to take down next. And we may even get Axel, or we may even get someone in to kind of help us with that conversation. I want to just take one of the questions because I think we've covered a lot of these as we go. Say I owned a share and it's gone down 6% in the last 3 months. Should you have moved on to something else? For me, it's the stock price moving 6% is not in your control, but did you take the loss? And is this one 6% loss, or is this, multiple 1% losses?
Yeah.
Right. It doesn't actually, in theory, it doesn't matter what the underlying is and what it does if you're in control of your own position sizing and your own risk management. A stock moving 6% is a bit of a kick in the nuts if you're still in it, but you can't be.
I guess it's the age-old thing. Just to answer there, Monkey Man's question, it's like, is there an opportunity cost? What could you have done with the money? What else could you have done that would have maybe generated you money or not made you potentially be down money? And also, is the instrument that you're holding paying you anything? Are you getting a dividend? Is there a yield? If you're holding a 6 or 7 or 8% dividend yield in the stock and you're down 6, well, you net up too. So it's not so bad, right? And also, it all comes down to not just necessarily the percentage movement on the stock, but do you still believe in the stock? Is the original thesis for going into it still alive, and you're right and the market's still wrong? In which case, you got to hold it, right? You got to hold it and be proven that you were right because you still believe in it. But the minute you stop believing in the trade, and you go, oh, I can't take that because it's a loss. Well, if it's unloved and even you don't like it anymore, just cut it.
Yeah.
Just cut it and move on. You don't have to stay married to every single trade out there. You don't have to win on every single trade that you put on. Your trade analytics doesn't have to just show endless green whilst you've got like a horrendous sort of cancerous loss in your account.
Yeah.
Like it's for, you've got to be a realist when you're trading. You've got to go, you can't have this ostrich technique where you go, right, I'll bury my head in the sands, but look at this P&L that I banked. You go, well, no, actually, look at your overall equity on your account. What is your account worth right now if you hit the button and close it all? And if it's nowhere near what you are sort of showing on your trading analytics, you're living in a false
this is the only
false life, right? You can't hide anywhere.
Cash is definitely not
So
king.
it's cold, hard
But if you
facts to face sometimes, but you go, right, you need to take some ownership of this. And
Absolutely. But if you start looking at opportunity costs, if you think, all right, I've lost 6% on this, what could I have done instead? Isn't that an easy way to set yourself up for FOMO? Like you sort of look, oh, I could have done this, I could have done that. And then you sort of all of a sudden jump into these trades that you shouldn't have done in the first place.
But this is where it becomes part of your portfolio, right? you'd argue that that discussion is exactly what they call the equity risk premium.
Yeah.
Right? If you know the risk-free rate of return at the moment in the UK is 4.25, I think in the States it's 4.5 still.
Yeah.
If you're looking at the S&P and it returns you 10%, are you realistically going to take on the amount of risk to make the difference, which at 4.5% is only 5.5% per year? Are you going to bother going through the heartache in order to only achieve 5.5% above the risk-free rate?
Yeah.
Maybe, maybe not. Maybe allocate a third of your portfolio towards the risk-free rate if it's not for you. But 5% risk, this is the problem. This is why the markets have been selling off, have historically sold off when the interest rates go up. It's because the risk premium on top of that risk-free rate, it starts to break down a little bit. But, I think if you've got part of your portfolio which is performing in line with the market, is your long-term view. Trading shouldn't be a long-term view. It should be get in, make a slice, get out.
Well, I mean, this is what we try and always say, isn't it, to our sort of client base? I mean, obviously it's up to them how much they want to allocate to trading on the high-risk products, such as the CFDs and the spread bet side of things. But we, typically you want to kind of put a gauge around like 5 to 20% of your overall investment pot
Of your own net wealth.
realistically, and you want a big chunk of it in some other stuff. You want it in some safer stuff. You want it in that risk-free return ISAs and premium bonds and all that good stuff, right? But then you come to this area of finance with the piece that you have, trying to make, 4.5% over a year in an ISA. Yeah, that's nice. But on this stuff here, you're looking at 4.5% weekly, monthly, or intraday. The opportunity is there with the leverage. So you go, right, I could get these pretty monumental gains with a portion of my wealth in a tax-free environment, but how do I protect it? And the answer comes back to where we started, which is have a percentage risk that you're willing to lose on each of your trades.
Yeah.
And then you are entering something which could give you magnified gains, but you've got risk management in place. And if you just come to it and go, well, I've got 100 grand and I'm happy to put 20 in here, and I'll just twist it up 200 times and YOLO, I might make $1 million. You're not going to make $1 million.
Yeah.
Okay. But if you come with 20 grand and you have a system and you have risk management and discipline, then over the course of a year, you could do something like that trade of the week return where you're getting 30, 35, 40%. And that's in a tax-free environment, right?
That's incredible.
And you go, okay, I've had a great year.
You don't have
a 20 grand ticket, I've taken, 4, 5, 6 grand tax-free. That's paid for, the holiday.
Yeah, no, you need
That's fine. That is fine. You don't need to come and make $1 million quid, right?
Imagine trying to.
I mean, everyone wants to,
imagine
but
trying to start any other job and you go, right, well, I'm going to be an expert at this overnight.
Yeah.
It takes time to work your way through and get promotions and work your way through different departments before you're in a controlling situation, before you start your own business and stuff. And it's approaching it in that way. So look, I want to round off the discussion. I think it's really important that we revisit the questions properly about position sizing and stops. There's 2 episodes that I'm going to come back to you, so you got my commitment there. But to round up what we've been talking about, discipline is easy to say, but it's really hard to do. Having risk parameters is the most important thing. If you can take anything from this conversation, percentage of your account risk, stops and limits, sizing of how many positions you run at the same time, those types of things, they seem boring, but they're so key. So risk parameters, having an exit strategy. I've seen so many people over egg how important it is that they're looking at this particular MACD, RSI on the way in and couldn't give less of a toss how they get out. That is just as important, if not more.
Think about all the people that made money in Coinbase, MicroStrategy, Bitcoin, all on that move post-Trump.
Yeah.
And how many thought, oh, it's still going higher. And it might be, right? But if you're getting gains like that, you've got to be taking something off the table.
Yeah.
You've done a lot of work to get to that P&L, to see that blue on the screen.
Exactly.
Let's put something in the account. Let's
The
take
good
some
times
off the
don't
table.
last forever.
Yeah, exactly right. But you say there on the discipline thing, you can do things to make your life easier so that weight on the discipline isn't as much. So that if you do the 1% and you do use a stop, then you make that part of your ingrained process. Almost like the sort of Atomic Habits type thing, where you just embed it as a habit. You go, right, I'm doing a trade, and when I do a trade, I have this 1%, and then you just know, right, my stop's there, and that's it. And then you don't have to worry about that discipline because you've got it in on the trade. It's on.
But it's been done for you. You are disciplined by having that. Away from the numbers, your question, do the declared 30% of people who are trading profitably with IG follow disciplined trade plans? Yes. you can't get away from the fact that yes,
the most successful traders that we talk to are almost like robots when it comes to P&L. They are dispassionate about the numbers. You know, oh, see, you had a great week. Yeah. I know that I could have a terrible week next week, but I've got a plan and I stick to it. So I go, okay, yeah, fine.
I'd also be really wary about the people that want to talk about their wins all the time.
Yeah.
The amount of people we've met over the years.
Anyone that saw weddings, no funerals. You got to go. There's something lurking here.
But the amount of people that we speak to that talk a really good game, and that you look at we look at their accounts, and unfortunately they're not profitable, and you just think these two things don't add up, and the ego gets in the way, and that's we're back to that piece we talk about bias and psychology. But look, guys, we're running over time. Thank you so much for listening to us. If you've listened to us live, we welcome to the world of Talking Shop. If you're listening to us on the podcast, it's great to have you guys back. Definitely watch Trade Live with IG. We do this every morning from 7:30. We are back in a fortnight, and I think we're either going to talk about position sizing or we're going to talk about stops. They both deserve their own episodes. So, gents, we're not going to get a margin call this week because we've run out of time. Maybe it's not appropriate for live, just in case we need to edit things out. So we're going to come back. We do a piece on the margin call where we pick the biggest loser in the market this week. We're not going to do that this week.
With Rich's tucked in t-shirt, I think.
You get the behind the scenes here. He's gone full Jordan Belfort, jeans up here, Nike Cortezes. He's all over the place today. Guys, thank you very much. We'll speak to you in a few weeks' time.
What a rally into the close. It is Tuesday, February 18th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York. We're flying solo today, folks. We're doing a bit of a different show here on Overtime. For the next 30 minutes, abbreviated version, I'll take you through a market recap, and I'll take your questions. Consider this a Q&A version of Overtime. Tell me what you're trading, what you're thinking, what you're looking at. We'll try our best to respond here in the chat. Production team, feel free to flag anything noteworthy of important to me. But before we get to the Q&A, let's talk about this market in today's session, which saw stocks surge, well, relatively speaking, into the close. We can share those charts here, Paul. We find ourselves looking at an S&P 500 that is up by 0.25% now, 6147, a 15-point bump there in the final few minutes of trading. The Nasdaq likewise finishes in positive territory, up by 0.2%. Your Dow Jones up by a paltry 0.04, and the Russell is overall the leadership group today, up by 0.61% here. We don't really need to go with the back and forth because it's just me, and we'll just go right into the sector performance here on this Tuesday session of Overtime. Sectors here overall, most of them are up. We track 20 here on futures, on Overtime. 5 of those 25 were in the red. 20 of the 25 were in the green. Top performer today, oil services up by 1.69%, XME up by 1.48%, SMH up by 1.44%. On the other end, the biggest loser, home construction, down by 1.19%, as our U.S. Treasury yields rise across the board. We see here that home builders also up by 1.14%. And then not that big of a loss for the third place loser, XLY down by 0.28% here today. There was a question already. Did we close at a new all-time high? S&P 500, not quite, but in the SPX cash index, we do. SPX cash closing here today in at 6129.58. This is a new all-time closing high for the index. The previous all-time high close comes here on January 23rd. That was 6118.71. So the beat marches on. Before we turn our attention to what's going on in other markets here, there were a few things on the equity side of things that, we'll say, drew my attention here today. In particular, the February Bank of America Global Fund Manager Survey came out. This survey, which includes 205 panelists who manage a rather large $482 billion in assets, finding 89% of those individuals see that stocks may be overvalued here. I had another chart to pull up, and there we go. That's what I wanted to look at. So let's go to what Sam Rowe shared today of the TKR. Definitely recommend following Sam on X, Twitter, Blue Sky, wherever you may be. First off, this is what we see here. fund managers, lots and lots and lots of bullish sentiment right now in the market. B of A strategist Michael Hartnett points out that an average of 81% of fund managers have considered U.S. equities overvalued throughout the 2020s so far. So the survey shows that 73% of investors see U.S. stocks as the most crowded trade, down from 80% in January. But this is perhaps the more interesting chart that's getting people talking. It's the fact that we're seeing that most investors and most fund managers are putting their money to work right now. Currently, we are seeing cash flows at 3.5%, a 15-year low. Investors basically are saying we need to get out of things that burn a hole in our pocket. The market's moving. We need higher yields. We need to be compensated for what we're putting to work. And so the money's out in the market. But it could be a sign of overall too much bullishness right now. There's a lot of crowded trades out there. This would be the time of the year, at least seasonally speaking, that one would get concerned about it. Great chart shared from Ryan Detrick, both visually and in the tabular form, if you want to look at the whole year on a seasonal basis, day by day since 1950. This particular stretch here that we're in right now, the second half of February, it's not usually a good one. The gains that we typically put up in the first half of the month, those are ones that are knocked backwards. Ultimately, is it a problem for us traders here who are operating on the long side? Boston Frank is saying SPYs and QQQs are at all-time highs today. That does appear to be the case when we look at this market in today's session. SPY, that's a nice thing for investors to see. They go home from work, they open up their 401ks, their SPY investments. Never been bigger. That's not a problem and certainly generates a little bit of a wealth effect in people's minds. So you have SPYs closing in at 611.45 here. We have the triple Qs. Those are in at 539.37. Previous all-time high close was on December 16th at 538.17. I'll get the words right sometime here. Stocks, they are continuing to move up. From my trading perspective, not sure what other people are doing here. Going into this week, I'm taking a look at my 6150, 6300 call spread that's still on. There's still a good time to expiry, 17 days, but we're rolling down the other side of the decay curve. So it's at the point where it does need to be rolled. That is a top priority tomorrow. We don't want to expose ourselves to a significant downdraft and then ultimately find ourselves, good idea, bad time. And so right now with the market trading in at 6148, I'm going to hold on to my skis here for another session. But these markets look like they're in breakout territory. And for a lack of an audience here that will, rather lack of a counterpart here that will push back on my bullish sayings, I'm going to stipulate that maybe a market closing at all-time highs isn't bearish, is probably a good thing. And so when we look at these futures, ESH5, that continues to push up. The NASDAQ futures likewise, they rebound after weakness earlier in the day. They're putting in their third highest close ever here in the futures market per this contract, only eclipsed by what we saw in the days preceding that that December Fed meeting here. I'm seeing a lot of people, or at least some, saying that they were trading 0 DTEs today. God bless you. Honestly, that is just not the market for me. I'm a little wordy. I'm a little convoluted sometimes in my political and macro thoughts. So I can't say that I'm that great of a scalper. I eschew it myself because I have to stick with what works for me. So those people trading 0 DTEs today, good on you, good for you. I really wish I could master that skill set. I see here someone saying that they are short gold or simply don't believe the move. They think it's short covering. What do you think? Vito, I think that's a great question here. It's actually one of my better performing positions. It's something I find myself on the opposite side of you, however. Last week or 2 weeks ago, rather, with Jamal, we rolled up the call spreads that we've been riding in gold from the start of the year, second week, when it looked like the symmetrical triangle was breaking out. Currently long the 2950, short 3000 with 36 days to go to expiration. And this is a new all-time high close for gold in the futures market. I mean, sure, we didn't set a new absolute all-time high today, but it's still a market that's moving up. And as a momentum guy who simply just tries to follow the trend, this is something that continues to trend to the upside. And then philosophically, if you're doing it short GLD just at face value, or if you're doing it through something like the options, I stay away from trying to fade gold, silver, really any asset that has a positive relationship with volatility by trying to sell calls. If the price moves up like it does today and you happen to see a spike in volatility, you can get whacked on both ends. I call it the double tap that I like to avoid. So I would rather look for a break in the momentum or the characteristics of the market that have defined the uptrend before I would even step in front of a move like this. And so to that end, what has been the defining characteristic of this market since we started breaking out? There's no moving average that's sacrosanct, right? I happen to like the 5, 8, 13, 21 EMAs because that's just going up the Fibonacci scale. Now, 5 is rooted in the logic of 1 week. 21 is rooted in the logic of it being the average trading month, 20.7 days. In between, though, if we take a look at the 13, as we break out here in January, this gap between the 5 and the 13 EMAs, it's been holding up. We haven't seen a breach of that zone thus far as this move and lurch towards 3,000 has continued. So I'm operating on the long side. The characteristics look like a bullish breakout. I'm not one to call a top. And granted, in a momentum trading style, if you're long, you're going to miss the top. The final trade in the chain will ultimately be a loser. And likewise, if you're shorting a market on the way down, it's going to turn against you at some point, and that last trade will be a loser. So, in this particular setup right now, I prefer to stay operating on the long side in gold, long side in silver here, which likewise is pushing back up with a $33, 37.5 close in the futures market today, now up to 33.43 after that official futures close. Both gold and silver up over 1.7% today, so shaking off that Friday weakness. Likewise here, I'm sticking with my guns and hold on to SIK5, that call spread that was established back at the start of February. I'm curious if anyone else here is trading gold or silver on the long side, how you guys are approaching it. There's a great cherry picks that just went out today. Dr. Data and Nick just put out a little section on GDX and GDXJ, the realized vol that you're seeing in the miners versus the junior gold miners. Highly encourage you to go check it out. I don't really trade the gold miners myself. I know people like Vic do. I know Nick, Dr. Data are looking at it right now. So if that interests you, those certainly have been at the top of the heap, soaring here in recent weeks, recent sessions, as we've seen gold, silver, what have you, absolutely crush it in 2025. To that end, XME, we talk about the general speaking materials, metals and mining ETF, that's bouncing up. But you notice it's not at all-time highs like gold is. So if you want to play gold and silver, probably just better to play the gold and silver. Good question here from Darren. I'm seeing a few on the NASDAQ right now, or before we get to that, Chris. Steve, Sam Rowe on Twitter. Let me just pull that chart back up for you so you can take a look at it. This fine guy here, at Sam Rowe. Great newsletter, great read. And then the other one was Mike Zaccardi. He publishes all sorts of charts. Fantastic follow on X. Definitely check them out. And then Ryan Detrick was the third one. Likewise, another great follow. Lots of interesting information if people are approaching the market from a technical quant perspective, where you're using price action and data around price action to help inform what you're doing. These three reproduce a lot of what you're seeing in financial media, Bloomberg, hedge fund analysis, right? They're either accumulating it themselves proprietarily or they're publishing what other people are doing. So information trove. Couldn't recommend them more. Quite frankly, I think I may be able to get rid of everyone else in my follow feed if I only had to whittle it down to those three people. Most of my market analysis would be in front of me anyhow. But let's circle back here. Talking about the Mag 7 names, there was an interesting move in Meta in today's session. It's the first day down in 20, but we do see that stocks push higher here. I would make the argument that Meta is weakening today because people are taking profits and they're rotating elsewhere. While Meta's down by 2.76%, the Mag 7, broadly speaking, is off by 0.72. If we want to think about the NASDAQ in equal weighted terms, that was up nearly 1% today, higher by 0.98%, and closes at a new all-time high. So breadth in this market is improving right now. So you have a QQEW at a new all-time closing high, a triple Q at a new all-time closing high. And I really think the story there is that the DeepSeek Monday has basically been vanished from our memory. I would posit, and I would highly recommend for people that don't take me at my word, go revisit the shows that we did from January 27th, 28th, 29th, talking about the DeepSeek news and what it may ultimately mean for markets. I was making the argument that we were shifting from phase one, the picks and shovels, into phase two, the gold rush, the applications phase, if you will. We've laid the infrastructure with the GPUs. We're now moving the bottleneck from the company that controls the infrastructure build out to the companies that control the applications, the consumer-facing, business-facing applications. Today, we actually marked an important milestone. NVIDIA closed the gap that we had from the Friday before DeepSeek Monday. And as we've seen this occur, that little basket of stocks that we've been tracking, as it were, compared to the broader market, we call it our phase two basket here. And I'm pulling that up right now to put on the screen. Bear with me. Am I going to pull it up on the screen? And it disappeared. Well, that basket today is hampered because of what happens in Meta. But overall, names like Amazon, names like FDS, FactSet, we've seen some upward movement here. SPGI has done quite well, S&P Global. Meta, of course, is part of that grouping that we were discussing earlier. Oracle, Palantir, among a myriad of names. The point here is that ultimately we were questioning whether or not DeepSeek meant that we had laid too much infrastructure, that all the capabilities that we needed to get to this next stage of the AI revolution were behind us. CapEx spending would crater. It was over. An important development occurred last night. Like him, don't like him, Elon Musk's Grok AI, XAI company, put out the new Grok 3 model. Now, the Grok 3 model hit some very impressive milestones. In fact, if you compare it to ChatGPT's 4.0, if you compare it to Gemini, if you compare it to DeepSeek or Claude 3.5 Sonnet, it is scoring higher on all the aptitude tests: math, science, language, learning. And it goes to show that this Colossus supercluster that Musk built with its 200,000 GPUs, it does actually produce the scale of improvement that one would expect if we're continuing to see these linear type of results. The too long didn't read version of that is compute matters. Compute matters if you're going to build better models still. You can do it the DeepSeek way. You can do it in a cave with a box of scraps like Tony Stark did. But you can also do it in a way that produces better results if you have the firepower. And if you have the firepower to do it, it took Elon Musk's company 18 months to get here from when it came off the ground. So clearly the infrastructure build out is working and it can continue to work. So we're moving from phase one to phase two, but we still may need more infrastructure. Semiconductors are at that top of the heap today alongside the miners. We see SMH is getting back to where it was basically pre-DeepSeek Monday. We closed that Friday in at 261.53. We're now at 256.22 after hours, basically 260 on the dot. All right, just reading through some of the questions here. Maybe it's a masterclass in AI copium. Seems to be working. We'll have to continue to push on as long as the theme goes, right? And this has been a point I try to make as traders who are operating in these shorter term cycles. These bubbles could build, these themes can run, the markets can stay irrational for longer than the typical 45 and 21 day out. And so if you're a longer term investor who's thinking about capital allocation and your longer term required IRR, you can look to a price to earnings ratio and say, you know what, I'm just not getting the value here that I want. This is not my risk profile. But for us to, look at one of these themes in the face and say, this is it, it's over, without the corresponding price action and call the top, that's difficult. And so while I'm a momentum trader, when it comes to the price action itself, is also a momentum trader thematically. As long as the pillars of the theme remain in place, then ultimately it should still bear fruit, even if you have to work through a period where there's digestion in the headline indexes. But that digestion may be ending, as we see with the triple Qs and QQEW continuing to push to those all-time closing highs in today's session. I would posit that Meta is probably the most interesting one to buy in a pullback if there is a little bit more opportunity. Broadly speaking, any of these proprietary data providers are going to be the big ones in my opinion, that succeed moving forward in this phase 2 name initially, because you need the data. You can't train models on slop. And a lot of what's been flooding the internet out there in recent years has been slop. That's why people are amending their Google searches with like pre-2023 or, Reddit first. Google isn't what it once was. I don't really use Google for search anymore. I bounce between the AIs. Theta says, blink twice if you need help. Listen, if you want to come on the show with me, feel free to come on. And Ilya's out this next week for vacation. He's traveling the country. Dylan was a little bit out sick today. Paul, we can do that. We can have guest hosts coming off of YouTube. That'll work, right? Is that allowed? I did something earlier in the chat about oil prices here, why they're moving up today. I suppose it's worth giving a brief discussion about what's happening in the Russia-Ukraine negotiations. Well, I should say the U.S.-Russia negotiations. Ukraine has been sidelined, and Zelensky canceled a trip to Riyadh, Saudi Arabia, to partake in the discussions. Part of the conditions for the ceasefire is for Ukraine to hold elections. I don't know. It feels like Zelensky is not going to agree to that, but let's forget that for a quick moment here. Consistent with the idea that we've discussed in recent weeks and months, that if there is a ceasefire and the sanctions are lifted, like it, don't like it, that's just the world we may be living in. Ultimately, then, a lot of Russian oil that's been moved around the world in shadow fleets probably can come back to the market at market prices. So that probably means a little bit of elevation. OPEC Plus today puts out an announcement that they're probably going to be slowing their roll in terms of boosting production moving forward. That's not a great sign. There was also a Ukrainian attack today on a Russian oil pipeline that affects the flow of Kazakh crude to the Black Sea. So oil gets a little bit of a bounce, up 1.6%. I don't have any oil trades on right now. I don't have anything on in a trading account for XLE. I have some accumulated XLE and XOP from over the years that I don't really touch. But in terms of directional trades right now, I have nothing doing in the energy space, well, oil in particular. Most of my exposure is still through that theme of AI and through natural gas, which today has a resplendent session up 6.95%, breaking out to a new yearly high here. We've been operating in the NGJ5 contracts, 36 days to expiration right now, sitting on that short put spread, and that's working out very neatly as a result. We're basically getting into the teeth of where max profit is starting to arise, so taking this off and resetting it is probably going to be my path moving forward. But as we've learned with this AI build out, right, and I think one of the reasons why we see this move in natural gas today and the associated energy names in the complex today is that we have this realization that we need the data centers and we need the energy to power them. There are companies that have done well in recent sessions that are playing into this trend. We've been talking about EXC as one of my favorite setups, Exelon Energy, as it goes through this potential bottoming process. They serve the Pennsylvania area, and Pennsylvania is going to be the location of some major data centers moving forward, Eastern Seaboard type stuff. Also, it's a data or an energy provider that doesn't really run the risk of wildfires. That is one of the problems that I've run into looking for names where data centers may be, particularly in California. Do you really want to have one of those names in your pocket, given what we've seen recently? So I like the natural gas trade. I much prefer to be trading natural gas right now. It's directional. It's breaking out. It has more volatility embedded into it. It plays neatly into a theme. I prefer to keep my long delta going there rather than look at anything in oil right now. Although contingency plan, let's say oil, all of a sudden we wake up tomorrow and we're at the same price, but it's an 85 IVR. Realistically, let's say it's a 40 IVR. I'm putting an short iron condor trade on here immediately. Midpoint of the 52-week range, juice then becomes worth the squeeze. But at 14.9, I just don't really see it for myself here as we look into this week. Andrew, this is a good question. How do I struggle with bonds so much? Great question. Yeah, that is definitely my my macro mind overriding the common sense of the technically driven momentum market here. it's beginning to look like what was maybe an inverse head and shoulders pattern. Now we're consolidating more into perhaps a triangle over here, which is frightening unto itself because in the context of the previous decline, it would mean being long is the absolute wrong call, wrong side of the trade. Top left to bottom right, this would be a symmetrical trying continuation effort. My shtick, though, is that we've seen some extreme pricing in Fed cut odds, and the world that produced the move in bonds, both in ZB and ZN, here at the start of the year was largely driven by fears that we'd be looking at, a spark runaway in inflation coupled with 25% tariffs. And as we decompose the recent inflation reports, the bump in transportation services more or less has to do with a rebasing of energy prices and motor vehicle insurance and people pulling forward purchases of used cars and car parts in anticipation of tariffs. So are those one-off type of purchases and events, a rebasing of oil prices, right? Last week's CPI report kind of rolls over us. I would posit that, yeah, if we're trading this purely technically, we're waiting for the next leg lower. I think you're absolutely right. But unless we get back to a world where we're only looking at one cut potentially through the end of next year and 25% tariffs across the board, we are looking at some headwinds starting to build for the U.S. economy, right? The economy is on strong footing coming into 2025, but the fact is that the data trackers that I look at and that I consistently look at for as long as people have seen me here on Tasty, the Atlanta Fed GDP Now growth tracker and the New York Fed Nowcast are beginning to show signs of topping out. The New York Fed Nowcast is not as dramatic as the Atlanta Fed GDP Now growth tracker estimate decline. That was at 3.9%. It's now down at 2.3. And so if we're seeing decelerating growth, that does mean that the balance of risk may be towards the Fed cutting if ultimately the labor market weakness begins to set in and the economy slows. We're not there. But this is not an environment where the Fed would even consider hiking yet. So getting, my mind off of that convexity of the long end of the curve, long bond position, it's been a difficult siren for me to ignore. But I keep getting punished for it. So the beatings will continue until morale improves, evidently. And I'm definitely trading in fear of my own shadow of what happened with the yen last year, when I was waiting for long yen for the first half of the year, then threw in the towel, and immediately the first trade I decided to not go in long yen again was the trade when it exploded to the upside. And that is a situation that I can't ignore happening here in bonds. All right. Just looking at some other questions here. I really appreciate all the commentary here. I'm trying to get to a lot of it. I'm seeing a lot of the same type of comments coming into this today. So if I mentioned someone's name, but you asked about, SPY or triple Qs or ES, just know I tried to get to it. So I do apologize for not calling you out individually. Defense contractors, as we close out the show, are those overblown? Look, there has been some weakness here. We talk about names like LMT, Boeing, Raytheon. They've certainly taken it on the chin, particularly since Donald Trump became the front runner in the race back in October. If you're looking at LMT or Raytheon or Boeing, any of these companies that manufacture arms as a potential guide for geopolitical risks, if you're looking at volatility in oil as a potential guide for geopolitical risks, you have to feel pretty good about things right now. On the other hand, if the U.S. is going to stop being the provider of the Western world's security umbrella, and if the Western world wants those bona fides, then they need to increase purchases of U.S. arms, there is a window with which the U.S. becomes the arsenal of democracy again. And if it serves as the arsenal of democracy, what weapons suppliers are going to be out there to help Germany and France and the UK boost their, military spending as a percent of GDP to palatable levels? Probably American arms manufacturers. So these are on my radar. Volatility is very high. LMT 95.9. Let's see a break of this 1 week moving average first, something that we haven't been able to close above since January 27th. And then maybe we can go fishing. But you know what, folks, that's it for today. Overtime is out of time. This was a special edition, only 30 minutes, abbreviated version here as both Spivak and Radigan were out. No one wants to hear me drone on for an hour, so I figured I'd save everyone that bit of pain. Hopefully it was a good trading session for you all. I really appreciate your feedback and your comments. Please do come back tomorrow, though. Overtime, we'll be back same time, same place here on Tasty Live, as we are every Monday through Thursday, right after last call, 4 p.m. Eastern, 3 Central. So I've been Chris Vecchio. Good luck trading. After this, video on demand, and then macro money at the top of the hour. Another video on demand with Ilya Spivak. But stick around. It's good content. See you soon.
What is going on? Welcome back to today's segment. We got some things to talk about. Pretty aggressive sell-off today, then a little bit of a rally into the close, but we'll touch on those things here in a minute. What's going on today, guys? How are we doing? What's new? I know we were having a lot going on this week. I believe Trump was supposed to be talking here and there, and then I seen more talk about that on the socials. But other than that, we don't have any earnings that are standing out to me too much, but we'll go ahead and talk about everything. But again, before we get into all of that, how are we doing today, guys?
I'm doing well. I'm having hardware difficulties here. This thing started popping out of my ear the second we started.
No,
going.
I know the hearing aids. The hearing aids, man, they're annoying.
Production just
I gotta
got me.
adjust
We're
mine
handled.
too.
We have the greatest production team in the world. They've figured it out. I've chucked the earpiece for today. But yeah, no, I'm doing really well. No new positions through the long weekend. I mean, it's obviously the first day back since the long weekend. I didn't find myself trading anything today. No super attractive spots.
Did you wake up Monday morning though? Did you wake up Monday morning opening or expecting to open up the market?
Well, no, I don't know. It's trading is it's become a little bit linked to coming to the office now. So when I woke up Monday and was like, oh yeah, no, I'm not going in. It kept me from opening up the platform. I do still have this DraftKings position that we talked about last time. They had one of the worst earnings calls I've seen in some time, and then it rocketed, as we discussed last stream. That's the way of the world.
Of course.
So there was a time when I was down like $200 on it. It's began to come back down a little bit. I'm down 100 now. Expiration is Friday. I don't think that I want to manage. It was supposed to just be an earnings play. I'm not going to extend this into some broader bearish sentiment that really doesn't exist at all with me as far as DraftKings and these gambling stocks are concerned. So I'm looking to close that one. Might be able to dip out, but my strike is 47.5. So it's kind of gotta die or I will die. Those are the two options. But outside of that, looking good across the board. What's up?
Yeah, no, I was gonna try and make it seem like the glass is half full. But 47.5, we are a little bit of ways away. But maybe the market will digest a little bit more and come back. So other than that, is DraftKings the only one you were pretty much eyeing this week?
Yeah, I mean that's my only one that I have to decide how I want to manage it. I'm also eyeing Amazon a little bit. It's come down. I mean, everybody we talked to, you had that Amazon trade. Everybody and their mom was bullish on Amazon around this office there for a little while. It's come down to 226 now. So I'm feeling like this is maybe a good range for a buy spot, especially at a discount, considering when it was. Well, it would be a discount to me, considering when it was alerted by everybody initially. So got my eyes on Amazon from a TA perspective. Haven't pulled the trigger quite yet, but it does look prime for a bounce. I'm actually just sitting here, and now that this day candle has closed, this is a nice butterfly doji here on the bottom. So. Yeah, think we could get a move out of Amazon. That'll be my main watch list tomorrow.
Looking at Amazon right now too. No, we're down a little bit. IV rank is decent. Volume is pretty decent. I'm looking at the 29 delta right now. That's giving me about $1.20, but with the $5 wide, I don't think that's something I want to take. I mean, the pop is 70%. That looks pretty decent. But until then, I'll keep an eye on it. That's in the 58 days till expiration, so I'm probably not going to get much more out of it if we go any closer. 133. That's not as bad, but then again, that's a 34 delta. I'll be patient on it. Not enough juice for me. But if we do continue to sell off a little bit, especially throughout this week, it'll make it more attractive because we're getting more of a directional move to the downside, and then hopefully I'll be able to collect a little bit more credit. Do you kind of like the vertical spreads as well? Is that more of your go-to with DraftKings, Amazon? What is your kind of style
if I
like?
don't want to be naked is the answer.
Okay.
I have no problem with going naked here and there, and on DraftKings I am naked. Just sold one call. So if I'm playing in earnings, or if I'm doing something where I know I'm spinning the slot machine in the first place, I'll just try to. I usually won't go covered. I'll just try to size my position accordingly and take a position that I would be prepared to lose 100% of. And so that's what my mindset was with DraftKings. But yeah, I like the verticals. If you want something that's a little more, defined risk. And sorry, I'm distracting myself looking at Apple here. I'm
No,
intrigued.
you're fine.
I'm intrigued by what this event tomorrow is going to bring, and I'm looking at the market sentiment here. I don't know. I mean, honestly, this is a bearish point in this chart if it existed in a vacuum in a purely TA sort of context. Clearly running out of bullish momentum. Sitting here looking at the Ichimoku cloud, it just crossed to red, which is a major bearish indicator. Channeling down. Yeah, this is interesting. But obviously, Apple is not a purely technical stock. And that event tomorrow is going to be interesting. They're rolling out a new iPhone SE. You seen that?
I didn't. What is the SE? What is the SE all about? Is it a similar? You know how they took the side quest when they made the colorful iPhones? What was it, like the iPhone Cs or whatever they were called? Is that going to be the same route they're taking there? And enlighten me there.
Yeah, that was the 5C. They only did the colored ones one time, I think. Now the SE is it's smaller. It's the same functionality, but it's smaller. It's like iPhone 4 sized. I mean, they're small, like 4 rows of apps. And I mean, I think that there's a place for it. I've actually been saying for years that I can't believe they haven't caught on more. And I guess Apple is going to heed that advice and take one more whack at it, because phones.
I'm sorry, you said it was going to be a smaller iPhone. Is that what you had said?
Yes, it'll be the same functionality as an iPhone 16, but it's just smaller. Is the only thing.
We've really came full circle.
Yeah, about I know. We wanted to go bigger and bigger and bigger, and suddenly we need to go small again. And I'm here for it. Like I said, I have I just recently got a 16 Pro, and that sucker is big. It's a big phone. It's big.
Well, what did you have before that? I feel like a lot of the iPhones kind of been the same size over the last 5-10 years now.
Well, no, I've actually been very surprised because I have my personal phone is a 14. I got the 16 for content stuff, but the 14 is like considerably smaller. I mean, I don't know. I mean, we're talking on the margins here. It's like an extra centimeter of both length and height, but when you set them on top of each other, it's notable.
Was it the Pro or the regular one or the Max or whatever?
The 16 Pro Max is the new one.
Okay.
Yeah, which I think is a little bigger, but they do just keep growing. And yeah, I mean, this thing, I can feel my phone in my pocket right now talking about it. So I think there's room in the market for a smaller phone, and I'm surprised they haven't made a more aggressive push for it sooner. I think it'll do well. I'm bullish on the idea, but we'll see how the market actually chooses to react, because we might be a little overextended up trying to price in this event.
Yeah, I mean, we might be a little bit. I know we're getting a rally into the event. I mean, just looking at the expected move on Apple, I mean, we can get a decent credit. We can get it just under a third of the width. So come Apple event, we'll see how that kind of pans out. Other than that, I haven't really been looking at two. Go ahead.
No, I was just going to say, these Apple events, it happens every time where the market, like in this case, I'll use the SE as an example, the market will say, oh my God, they're going to announce the SE. They're going to announce the SE. And it runs up and it runs up, and the event happens, and the market's like, what the hell? They only announced the SE. And then it goes back down. I've seen that Apple pattern happen a lot surrounding these events before. So I'm expecting there to be exactly what was promised, and then the market to be underwhelmed for some strange reason. That's sort of my prediction.
You think it's kind of like a sell the news kind of vibe?
I do. I think that anybody, Joe Public that just started trading yesterday is aware that there's an Apple event, and that's probably going to do good things for the share price. And that's, I mean, it's like what we talk about pre-earnings. Sometimes a good earnings will get overly priced in to the extent that even once the good earnings is reported, it just goes back down.
Yeah. I hear you. To do a little tour to market real quick. I know we kind of rallied into the close, a little bit of a sell-off coming into the morning. I mean, exactly at 9:30 Eastern, we had a little bit of a sell-off, sold off throughout the next couple hours, kind of consolidated through midday, and then we had a rally into about the last 5 minutes of market open. But we'll circle back around to that. Volatility increasing a little bit today, especially into the open, and then as we get into the close again, a little bit of a decrease in volatility as the market started to rip to the upside. Give me a second here. We'll get this, and I guess we'll go on to SPY, and then SPY trading at near all-time highs right now as well, and then QQQ following suit. I believe QQQ is not all the way at its all-time highs, but I mean it's getting there. But no, volatility is really nothing to write home about. / am I typing this in? Here we go.